That theme, but looking to build on it this morning. Let's have a look at a few assets to give us a sense of where we're going. This is the rally in Asia then on the back of the US CPI print. This is the further to go, though, that perhaps we have. US futures pointing just a little bit higher. The European futures, Tom will show you in a moment. Also some positivity. The pound is down 0.2% on the back of that bigger than expected drop in the inflation print, coming really substantially down. But that was expected because of energy prices. And talking of energy prices, just ticking up a little on Brent, 82.63. Tom, what do you see on futures?
The FTSE 100 futures is the standout, looking to gain to 0.6% back above 7,500. DAX also looking to add 19 points. Over in France, you're looking to add 7 points at this point, Anna.
Okay, so looking for a little bit of positivity at the start of the European trading day. US futures, as we pointed to, also suggesting a little bit of positivity. So maybe there's a little further to run on yesterday's post-CPI theme, but maybe we're nearly done with that. We had the UK CPI print, of course, to reflect on and think about this morning here in the UK. So interesting to see how gilt markets open up, and there they are. So we see the sovereign bond buying here in the UK, certainly at the 2-year horizon, and those yields coming down. There we are, the 2-year yield coming down just a bit, not a big move though compared to what we saw yesterday after that US CPI print. So CPI data coming in weaker than expected was yesterday's theme, and the UK is just sort of adding to that this morning. And here's the pound down by 0.2%. This is the FTSE 100 then up by 0.7%. The Italian FTSE MIB also showing some gains. So perhaps the FTSE in London giving us some bigger gains than we maybe had anticipated. The euro is pretty flat this morning, the dollar pretty flat, but of course a big dollar move in yesterday's session, and a lot of other assets, other currencies, sovereign bonds, all moving on the back of that dollar move yesterday. And a mixed picture really coming through on commodities. Tom, what do you see on the sectors?
So green across the screen when it comes to your sectors. Basic resources standing out with gains of 1% so far in the session, which is significant given that basic resources was one of the leading sectors yesterday, adding about 3%, more than 3% as a sector in terms of the upside that came through yesterday. Real estate, by the way, is at the top of the list with gains of around 7% for that sector yesterday. Basic resources up 1%. Tech also gaining, of course, on the slightly softer yield environment, up 0.3%. The consumer sector is adding 0.8. Retail did very well yesterday as a sector that is building on those gains with further upside coming through today. Gains of 0.3%. Again, every single major sector in positive territory this morning. Yesterday, just 2 sectors in the red, including energy. Today, though, energy up 0.1%. Food and beverage also posting gains of 0.7%. And the banks liking the picture in terms of the slowdown in inflation, gaining 0.4%. Across your benchmark here in Europe, adding 0.3% so far this Wednesday, Anna.
Okay, let's have a quick check in more detail then on what's going on in gilts. We caught a glimpse on the GMM screen of what's happening with gilt markets, and the gilt market really moving in kind of in keeping with what we're seeing in the rest of Europe. We're seeing yields coming down a little bit today, and if I'm looking across the UK curve, this is a pattern where we're seeing from 2 years out to 50, we're seeing the same sort of pattern, but more pronounced at the short end. So a move at the 2-year horizon in particular. Now, let's talk about what's going on in the auto space. Renault is targeting more than 10 billion euros of revenue by 2025 for its electric vehicle and software arm called Ampere. The French car maker revealed the goal ahead of a capital markets day that's taking place in Paris, where leaders will lay out the case for listing the unit in an IPO next year. But the listing faces plenty of headwinds, from tough market conditions to a valuation seen by some as too ambitious. Lots to discuss then. Bloomberg's Caroline Conan is on the ground for us at the event in Paris, and she's joined by the company's CEO. Very good to see you this morning, Caroline.
Anna, I'm very happy to be joined by Luca De Meo. He's, of course, the Renault Group CEO from this Ampere Capital Markets Day. Good morning. So
good morning.
Today, this afternoon, you're launching a new affordable EV car called at the moment the Legend. What can you tell us about this new car and how it's going to compete with the likes of Tesla, for example?
Oh, I think it's a different segment. Actually, you're talking about the new generation Twingo that we completely reinvent. So it's basically a urban car. So electric technology and connectivity give us the chance to really change the game, as the car 30 years ago did. And so I think everybody will be, very glad and happy to see such a funny and, advanced product, which will be very affordable, actually.
So it's going to be less than 20,000 euros.
Yeah.
What's going to be the final name? Where is it going to be produced?
Is the Twingo, because it's we like to use, to kind of revamp or reinvent the iconic product of Renault, like Renault 5, Renault 4. So we do the third one. So as you said, it's like below 20,000 euro. We're trying to shoot for a production, of that kind of car in Europe. It's a challenge from an industrial point of view and financial point of view, but we like challenges at Ampere.
It's going to be made in Slovenia, probably, right?
It's one of the lots of options that we have, because today the electric Twingo is produced there, so we have to find a solution for all the plants, but the decision has not yet been taken.
You've been to China recently. There seems to be a lot of pushback in Europe for the Ampere IPO. China is, of course, the land of affordable EVs. How is Ampere received there compared to how it's received in Europe?
Let's see what, because this afternoon we'll have the chance to actually describe in detail all the projects. So a lot of speculation so far, but without really knowing the number, right? So I think that people will see that this is a very solid project that we've been preparing for more than 2 years. And so I hope that, of course, the perception will change. That's our job. But I have to say, I was surprised in China, first of all, to see how enthusiastic and driving is the whole economy towards electric cars, connected cars, and that everybody knew about the Ampere project. So that's kind of reassuring, shows that they're looking at us, and they consider this project a very serious project.
In Europe, there seems to be some pushback from some investors about the Ampere IPO. Yeah. Some analysts even say that a spin-off could actually be a better option. Do you think a spin-off is an actual possibility?
I think the options are open. We are driving towards an IPO simply because of the fact that accessing to the resources of the investors will enable us to accelerate all the plan. And therefore, if you do this, basically you are able to even earlier to move dividends up to the shareholders, and also this money will also help us to develop products and technology, etc. So we don't necessarily need the cash of that, because Renault is actually right now doing pretty well. But it's also a way, an IPO, to create a certain culture, and we want to create a very, very modern and progressive company. And I think being listed is also important to, nurture a culture of performance, of transparency. This is the logic behind it. But we are not going to do that at any price, right? So this is, we have a lot of assets in Ampere, a lot of competence, and those have to be valued by the investors. If not, then we'll have other options.
Some investors actually talk about a valuation between 5 and 7 billion euros. You were talking about a valuation between 8 and 10 billion euros. What if it's 7 billion? Does that still make sense?
Look, I think we have our own, let's say, math on the thing. We know what the assets are. All these things that I've seen in the press is just like an estimation based actually on the information that was available. So this afternoon, people will be able to build a model based on the figures that we give. So let's wait in a few hours, and then let's discuss about that.
As part of the revamped alliance with Nissan, you are putting a 28% stake you have in Nissan in a French trust.
Yes.
How soon will you be selling that stake?
Yeah, I think very soon. I mean, and we have a deal with Nissan to do it in a pretty coordinated way with them. So we don't want to create any governance and let's say issues with them. So I think it will be a smooth process. But as we said from the beginning, we're going to use that money for other things. So we're going to gradually sell with the time, the 28%.
When you say very soon, when is that? Is that beginning of 2024?
Yeah, possibly. Yeah.
possibly in the first quarter?
Yeah, possibly, yeah.
Some analysts from Auto estimates that you could sell about 5% of that Nissan stake per year.
Yeah.
Is that a good expectation?
I think we have into the deal, let's say, a construction where also for different technical reasons, you don't want to get too many, let's say, shares in the market immediately. So that kind of dimension seems to be, within the logic that how we have constructed the whole thing. So I would say, you can expect such kind of thing.
Finally, if you're obviously selling that stake quite quickly and you don't necessarily need the cash, like you said earlier, would you actually need this IPO of Ampere at all costs?
At all costs, no, that's for sure, right? But again, I think that we are all in a business where, the stock exchange is there also to, foster performance, transparency in the activity of the thing. So I think it's a good thing, to list a company, and because it means that to get there, you need to have a very, very solid case. So it should be reassuring for everybody, okay? So, but as I said, we are not obliged to do this. We are not on a hurry. We think we have potentially a window of opportunity in spring 2024. But let's see how the markets evolve. Right now, the situation is, kind of a pretty depressive. So you don't want to be, you don't want to put yourself in trouble. We don't need, but we wish for the reason I mentioned before.
Luca De Meo, thank you so much for being live on Bloomberg TV from this Ampere Capital Markets Day from the Renault headquarters, where they're going to launch the new Twingo EV later today. Tom, Anna?
Caroline Conner, thank you very much indeed. The stock currently up 13% year to date, down though on the session. Caroline Conner out there speaking to Luca De Meo, the Renault CEO. Let's bring in Sam Umstead now from our Markets Today blog, and the focus switches to this UK CPI data, which again seems to confirm that central banks are getting a grip on inflation. What about the UK consequences of this then, Sam?
So I think it consolidates a lot of what we saw happen yesterday. So like we sort of mentioned earlier, the US CPI report took a lot of the wind out of the moves today. Probably still going to see, the FTSE 100 is up. I think you probably see the FTSE 250 do reasonably well, but not quite to the same level that they did yesterday. But you are seeing BOE bets go down. So I think that narrative that peak rates have been reached and the question of when is the Bank of England going to cut, that becomes the central question now.
Okay, and now a lot of people look at the UK market for dividends. So even at a time when a lot of international investors aren't finding too much to get excited about in the UK, some, you talk to income investors and they're still interested in the dividend story. So interesting that we've got this story this morning that says that dividend payouts have slipped in the quarter, but are still on pace for a winning year. So what's the overall story here?
Yeah, so this is a Janus Henderson report, and it's global dividends, so it's taking the picture across the world. But you're quite right that the UK, that's often talked about dividend paying and also increasingly buybacks. So returns to shareholders are a big part of what makes the UK attractive. And I highlighted this story really because there's Vodafone yesterday. So Vodafone, one of the sort of core dividend-paying stocks that people buy in London, on their earnings call yesterday, they didn't really commit to exactly how much their dividend may or may not go down because they're obviously in the midst of selling assets. So their cash flow is going to go down. And their shares fell quite a bit. And I think we've actually seen that through the earnings season. Any kind of disappointments on capital returns have been taken quite poorly.
Yeah, really interesting. Any caution and the stock gets burnt for that. Of course, Vodafone, as you say, going through their own restructuring plan. Sam Umstead, thank you very much indeed from our Markets Today team and Markets Today blog. You can get more analysis from Sam, the rest of the team, on the front page, of course, of the UK website, the Bloomberg UK website, or by typing TLIV GO on the terminal. Coming up, China's President Xi arrives in the US ahead of a very high-stakes summit with President Biden. Back home, Beijing pumping more cash into the banking system. We discuss that next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Markets Today, 15 minutes into the European trading session, and actually some decent gains coming across these European equity markets. A combination of a continuing theme of yesterday, central banks being perhaps done when it comes to hiking interest rates. That's the message coming through from inflation data on both sides of the Atlantic. So that's part of the story. Also some earnings in the mix as well. Let's check in on the individual stock movers. Joe Easton has a briefing. Joe.
So Alstom shares absolutely slammed in the opening of trading in Paris. They were down as much as 15% at the open. They're coming back up a bit now, down around 9%. It's all about the capital increase that the CEO was speaking to Bloomberg about earlier, potentially €1 billion analysts are predicting. That's the big shock from the report. That stock actually rose about 20% since the last profit warning, but we're erasing a lot of that today. It's the worst performer on the stock 600 that we've got at the moment for the French train maker. Now, we've also got Siemens Energy, €15 billion worth of guarantees, a lot of that coming from the German government, a little bit coming from Siemens AG and some banks as well. We're seeing it also feed through the positivity into Siemens. Now, as part of this deal, Siemens AG will buy a stake in Siemens India from Siemens Energy, potentially sell it back later on, and that is being seen as a positive outcome for both those stocks at the moment. Down the bottom, we've got Infineon. Sales forecast slightly below estimates, but sales estimates were reduced heading into that following their warning from around a month ago as well. As Sam Unstead reminded me, that's also a Siemens spin-off from around 20 years ago. That man's knowledge never ceases to amaze me. We'll go on to the second board now. UBS are brought up as a stock to watch. They're in court today over in France about a potential case around wealth management. Did they help clients to hide some funds? We're expecting to get a ruling on that potential €1.8 billion fine for the company there. You mentioned earlier the inflation coming down in the UK. We're therefore seeing a boost in home builders, also the banks, as well as gilt yields continue to come down. A 15 basis point drop yesterday, and we are seeing that feed through there today. Reckitt Benckiser, they've got a new chairman coming in. Bit of weakness over there. People aren't very loyal to their limescale remover, according to analysts at the moment, but they've got a new chairman. We'll flip over very quickly to the last board, a downgrade for Ahold delays in the grocery space. They are cut at Morgan Stanley. Compass Group upgraded over at Deutsche Bank. We got a couple of earnings at the bottom here. Alcon over in pharmaceuticals, getting hit in Switzerland, and Experian in London, boosted following some strong sales growth for the UK company.
All right, Joe Easton from my equity team. Thank you very much indeed. So some of the individual stocks, from the focus there to the scrutiny on the China-US relationship. And Chinese President Xi Jinping has arrived in San Francisco for a high-stakes meeting with his American counterpart, Joe Biden. Their talks on the sidelines of the APEC summit come as China seeks to boost confidence in its slowing economy. Let's bring in Bloomberg's Rebecca June-Wilkins out of Hong Kong then. Rebecca, what are you going to be watching for in terms of what could move the dial in this relationship?
Well, it looks like we're on the cusp of two sort of bigger ticker items. One is this deal on fentanyl, and the second is this resumption of military-to-military talks. Now, interestingly, both of these items are things that the White House, that the US have been pushing for very hard, and that kind of reflects in some ways the imbalance in the nature of the China-US relationship at the moment. China really needing to stabilize ties, and also, to some extent, appreciating this is a short window of time that it has to try and improve things before the US election cycle really kicks underway. The other things I'm watching, I mean, the discussion around Taiwan. See this time will be that dinner he has with CEOs from American firms, given the weakness in FDI in China at the moment.
Yeah, really quite very unusual scenes to see the Chinese president in the United States, so worth lingering on that subject for a moment. Let me ask you about the data, though, Rebecca. Your big takeaways. Some people talking about, yeah, sure, a bit more strength in the retail environment, but actually property is still the big story.
Yeah, I think that's absolutely spot on. I mean, on paper, it looks positive. So retail numbers, industrial output, both of those coming in better than expected. But ultimately, you just need to look at the property. That contraction over the past 10 months, worse than we thought, really not seeing signs of the support and stimulus showing through in the numbers so far. We did have that scoop from my colleagues about this 1 trillion yuan that ultimately might mean sort of low cost of funds going to potential home buyers. So this is directly putting funds in the pockets of potential home buyers. That could offer some support. But as you say, the numbers themselves still very weak. It will be the number that most people, I think, are focusing on looking in that raft of data today.
Rebecca, thanks very much. Bloomberg's Rebecca Jung-Wilkins joining us there with some of the China themes we're reflecting on this morning. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back. Now, Siemens Energy is gaining this morning after the manufacturer laid out its plan to return to profit next year. That's after a government-led deal helped secure financing for large-scale contracts and offset ongoing losses at its Gamesa wind business. Siemens Energy CEO Christian Bruch spoke to Bloomberg earlier about the aid.
It's not loans, it's guarantees which are used to performance guarantee contracts. I think this is where we have to be clear. What we are doing at the moment, obviously in terms of the guarantees, is simply continue to execute our business and continue to take new orders. This is what we need the new guarantee package for and what we are agreeing with the banks. The other thing is about what are we doing about our balance sheet. And you have maybe read also in the press release that we obviously continue to strengthen the balance sheet. We look into proceeds between $2.5 and $3 billion to strengthen this, and we will continue to do so because we want to stay committed to investment grade rating in terms of activities. We are looking at all measures, but this is obviously what we are doing at the moment, and obviously the $2.5 to $3 billion proceeds cash in is obviously from certain disposals an important element which we have in the fiscal year 2024.
Well, a big part of that assumes that the issues in your wind business will actually get fixed. Can you give us a timeline of how long that's going to take?
Yeah, thanks very much. And absolutely, I mean, what we did since the Q3 announcement, when we announced the quality issues in the onshore business, we obviously did a rigorous technical investigation. We have not seen any new findings on the quality side since then, so that's a good sign where I would feel comfortable to say, hey, we have analyzed it, and now it's about planning the implementation of the corrective measures and the containment measures into the fleet, which will go on for a couple of years, because keep in mind, most of the turbines are operating, but they will obviously need in the next years to come a repair package, and this is something which we work through. At the same time, it's about obviously bringing these corrective measures into the new turbines, which we will restart to sell going forward. But this is about the onshore business. And the second piece, which we always discuss about the wind, and this is a separate issue, which I think we also need to look on it separately, is the ramp up in offshore. We are the largest provider of offshore wind turbines, and obviously we ramp up 4 factories at the moment, and the output and the productivity was not there where it needs to be. This is not about quality, this is about workforce, training them, get faster, cost out, right, and really launching these new products into the offshore market.
That was the Siemens Energy CEO, Christian Bruch, speaking to Bloomberg's Kriti Gupta. That conversation a little bit earlier on this morning. Just saw some more further lines from Bruch crossing, talking about cost estimates around turbines and Gamesa. So this story, more news developing. Coming up, where does slowing inflation in the US and the UK leave the ECB? We'll get the view from the European Central Bank Governing Council member Mario Centeno. Joins us for an exclusive conversation. That's coming up next. This is Bloomberg.
invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg. Welcome back. This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. Cooling down. European stocks and US futures rally after an unexpected inflation slowdown in the US bolsters bets that the Fed's done with hiking rates. The greenback falls by the most in a year. Sterling holds losses and gilt yields fall as inflation in the UK tumbles to the lowest level since 2021. Traders add to Bank of England rate cut bets. Plus, Siemens Energy gains as the renewable energy giant sees a return to profit next year.
Okay, let's check in on these markets then. If you're a bull on equities, you have a number of themes to hang your hat on, whether that is the slower inflation trajectory, the lower inflation trajectory here in the UK, or, of course, the print that came through from the US yesterday. You're looking then at building on the gains on the upside that we saw coming through from European and US equities yesterday. The European benchmark stock 600 adding 0.5%. The DAX over in Germany adding 50 points at 15,664. And here in the UK, on the back of inflation falling to the lowest levels in 2 years, adding a full percentage point. The FTSE 100 trading back above 7,540.
Let's get into a really interesting conversation now. US inflation broadly slowed in October, which markets cheered as a strong indication that the Fed is done hiking rates. But what does that mean for other parts of the world? What should investors expect from the ECB? Joining us now in an exclusive interview, Mario Centeno, Governor of the Bank of Portugal and European Central Bank Governing Council member. Governor, very nice to have you with us here on the programme. Thank you for joining us. Clearly, we're going to get into the specifics around the ECB, but just to reflect on the global picture, the global mood first, we see markets increasingly coming to the conclusion that central banks and the Fed are done hiking interest rates and we get more cuts next year. Where does that leave the ECB?
Well, good morning and thank you for having me. The ECB has a very clear statement on the decision-making process. We are data-dependent, and these data really are good. They show that inflation globally is falling. The same thing is true for the Eurozone. We got a number for October that is already below 3%. We must be patient, but we have this feeling that we are doing our job. And the economy is reacting.
Yes, I mean, clearly you're focused on the European data, but is it easier to pause and to cut in global company? It's easier to do that when the Fed is doing it.
No, I mean, we have our numbers, and we, of course, set our policy to the euro area. And these numbers, they are shared by most economies, also the euro area. Inflation is coming down faster than it went up. This is a very important thing to remember.
Yeah, I mean, as we celebrate 4.6% here in the UK, 2.9% across the Eurozone, so that divergence is still there. Christine Lagarde, on the time frame, has said rates will stay at this level, 4% in the Eurozone, for some time. Where does that for some time take us? How far into 2024?
You know, data will tell us. The euro area is not growing for already 5 quarters in a row. This is a long period of time of stagnation. We need to move ahead, of course, but that will be determined by data.
Markets are pricing in first cuts coming through, what, April of 2024 for the Eurozone? Does that seem appropriate?
Well, you know, again, so far we have been implementing this policy that is aimed at bringing inflation to 2%. In September, we said, and we still believe, that we did a substantial contribution to that to happen with rates at this level. We need to follow up on this.
Are you at all concerned about a re-acceleration in inflation? Tom was referencing Eurozone inflation at 2.9%, Portuguese inflation at 2.1%. Are you expecting inflation to accelerate at all, given the risks?
This convergence to 2% will be slower from now on. November, we still expect a very good number for inflation, but then there will be some, I'll call it, resistance. We know the sources of this. There's a little uptick of inflation coming from energy. This is a base effect. But overall, what is important is the medium term. And our forecast puts inflation in 2025 at 2%. So we need to have that in mind. Anchor expectations. This is the main job of a central bank.
You're a labour economist by background. You have that deep expertise. Wage growth across the Eurozone. Is it your expectation that wage growth has peaked and is on the move down?
We don't see any signs of second-round effects. Actually, real wages since the beginning of the inflationary process fell by 6% cumulative in the euro area. This is expected to recover a bit, but that doesn't mean that second-round effects will be materializing. The labor market in Europe is very strong. It's showing signs of flexibility, adaptation that were not known in the past. We've moved away from this very sclerotic labor market in Europe, and these are great news for Europe. Europe did much better than other jurisdictions through this succession of crises.
Right, but now facing some real economic challenges. We think of the energy challenges, of course, that have been managed over recent months. Mario Draghi thinks that the Eurozone is probably already in recession. Do you think so?
Well, the numbers have not been great. 0, 0.1, minus 0.1 quarter on quarter for 5 quarters in a row creates a little bit of anxiety over, will this be a soft landing? This stagnation of the euro area is, of course, a source of concern for all. It will help bringing inflation down, that's for sure. And of course, monetary policy sometimes also has this side effect, which is the main channel, actually, of our transmission to the economy of our decisions. We just need to follow on the data. Again, the labor market is the pillar. It works pretty much as a dam to protect workers, firms, but it is a derived demand. It is the result of the economy, so we need to follow it very closely.
On the emergency program, the PEP program, so the Pandemic Emergency Purchase Program, and the reinvestments, so the ECB has signalled that reinvestment will continue until the end of 2024. Is that time frame still appropriate?
One of the greatest successes of this cycle of monetary policy hiking in the Eurozone this time was our ability to keep financial stability, which is a precondition to price stability. It didn't happen in the previous hiking experiences, but this time we've been quite successful. So anything that we do that is not focused entirely on price stability, keeping financial stability will not be on our menu, but we need to reduce the balance sheet. We know that, and we will do it, but always having undermine this prerequisite of keeping financial stability.
And is there merit in accelerating the wind down of APP? Whilst we're talking about these purchase programs, what's the latest on that one?
Reinvestment stopped with APP, so I think that process is set to continue. I don't see, honestly, no reasons today to accelerate it. Again, we need to do this in a very secured way. Europe in the past was seen as not the bad guy in the room, but as a source of problem. There were always existential problems around the euro. You don't see this time.
And are you
concerned? And this is a great success.
And are you concerned that if it's not managed well in the way you described, that this could create volatility around Italy in particular, which is perhaps where some of those concerns have focused in the past?
But so far so good. We've been able to manage all these sources of past instability. They are not present today. It's a common job for fiscal, for monetary. The coordination of these two policies for Europe is essential, crucial. It's a very important moment in 2020, and we need to continue on that spirit.
We need to switch focus, briefly at least, to the politics of Portugal, and of course the surprise resignation of the Prime Minister, Antonio Costa, and suggestions that he kind of reached out to you as temporarily taking over in the Prime Ministerial role instead of going for elections. There was pushback on that. Tell us about your views in terms of your stance. How clearly are you committed to your central bank governor role, and would you consider a second term?
I just got a phone call, which honored me a lot, but that's for the past. I never switched my attention away from central banking. This is my role today. My agenda kept going through the past 2 weeks, and it will continue doing so.
And you want to go for another term, Governor? Because I think you were asked to consider the conditions under which you might take a different role.
No, but that was for this other part of the small story, which was intended to help the country in a very difficult moment. But again, that's over. We will go to snap elections, which is how democracy works, and we will be good.
Do you have political ambitions at some point, Governor?
Not at all.
Okay. In terms of the, they're very clear on that. Yeah. No political ambitions. Let's see if we revisit that answer. In terms of the economic impact then on Portugal as a result of this, of course, unexpected, as we said, happened last week. The elections in March of next year. Do you have an assessment? Do you and the team at the central bank have an assessment as to the economic impacts on Portugal?
Uncertainty does not go very well with economic growth and stability. So we need to focus on what is important. Actually, I think the market's reaction to all of this was quite okay. We didn't see any reaction, essentially. Portugal is performing very well under the circumstances in which we are. Debt is falling for both the private and the public sector. The economy is still growing above what the numbers we have for Europe. Inflation is falling. The labor market is performing outstandingly. We have the largest number of workers in Portugal that we ever recorded in history. Low unemployment, wages are growing, so we need to keep up with this.
Your focus, obviously, on the monetary side of things right now. European leaders are trying to agree new fiscal rules. There are questions over whether they will reach an agreement. How much more difficult does it make your job on the monetary policy side if you don't get agreement on new fiscal rules?
We do have to coordinate all times, and that's not exactly how Europe stood in the past. But on the fiscal side, also Europe had a much more measured set of policies than other jurisdictions. I can tell you a number. 2021 and 22 deficits in the US were 17 percentage points higher than in the euro area. This is a massive fiscal impulse that, of course, had a demand impact, inflation. Europe was not playing that game. So fiscal in Europe played a much more consistent also with the monetary side. We need to continue that way. I mean, we can review and revise the Stability and Growth Pact rules anytime, but we must understand that existing rules work. They brought Europe to a stability path, and that's very, very important to be.
Governor, thank you so much for coming into the studio here our European headquarters. Mario Centeno, Governor of the Bank of Portugal and ECB Governing Council member, of course. Thank you. Coming up, Infineon gains as the German chipmaker's guidance reassures investors. More from our conversation with the CFO of that semiconductor company. That is next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. A new industry is poised to launch. Electric air taxis are on the horizon.
You will see these products come to market by the year 2025.
CFO Mark Messler has Archer Aviation on a financial path to a smooth takeoff.
I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
Watch Chief Future Officer Wednesday on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The reason why we are guiding Q1, I would say, a little bit conservatively also on the revenue number is that we expect a couple of things coming together. As you know, many companies and many customers of ours are going into year-end, so we expect some inventory management around fiscal year-end for our customers. Therefore, we only guide automotive flat in Q1, whereas for the rest of the year, they grow above 10%. And for the consumer market, as I said, we need to see some further inventory digestions, which will take a couple of quarters according to what we hear and see from talking to customers.
Okay, so that's a little bit of detail on the inventory management that you're seeing. How does that play into the order book, the order dynamics, Sven? Are you seeing, given some of the pressures across this global economy, are you seeing any pushbacks in terms of orders, in terms of timeframes? Are you seeing any cancellations? How are the order dynamics shaping up?
Yeah, look, that's a question we are getting very often because we should not forget we are coming out of this very, very extended period of allocation of demand-supply imbalance. We still now have an order backlog, so that's the sum of confirmed and unconfirmed orders of close to 29 billion. This has come down gradually from 32 over the last quarter, but if you compare 29 billion to our revenue guidance of 17, you see how strong the order backlog is, and more than half of that is the automotive order backlog. Of course, there are cancellations, but there are also new orders coming in. There are push-outs. That's a very normal behavior, but it is, compared to historical patterns, still, I would say, unnaturally high. So we are not getting concerned if it contracts further.
The Infineon CFO there, Sven Schneider, talking to us a little bit earlier on this programme. Let's stick with this theme. Shares in Infineon are higher this morning. That's after the German chipmaker said it sees its revenue growing by about 4% in 2024, thanks to demand from the automotive sector. Joining us now is Bloomberg's Aggie Cantrell, who's been looking at the details behind these numbers. Then, Aggie, what were your key takeaways this morning?
Yes, so looking at that guidance, Anna, it really is probably a little reassuring to the market, especially in comparison to some of Infineon's peers that were more downbeat when they reported earlier. And so what we're seeing from Infineon is actually their massive exposure to the autos market. It's about over 45% of the company's revenue. And while, as Sven Schneider said in that clip that you just played, that yes, there is this concern around Q1, the reality is that for the rest of the year, that's really where they're going to see that push. And electromobility, a big push for the auto industry at the moment, means a lot more semiconductors. So Infineon is well positioned, both in electromobility and also in other areas like renewable energy, to really capitalize on current trends for a lot of their customers. And so that's really where we're seeing the focus for Infineon, and where they've been able to capitalize on something that perhaps some of the other chip makers that supply industrials have had a bit of a harder time to do. And so, yeah, revenue growth of around 17 billion euros for 2024. That is going to be growth at a slower rate, but it is still positive in a broader market where essentially there's this continuous game for the chip makers of being able to predict customer demand and be able to predict what end consumer demand is also like. And that was something that was interesting that Schneider brought up in his conversation with you both earlier, when he talked about the fact that COVID restrictions being lifted in China, there was this assumption that the people were just going to go back to consuming. And we haven't really seen, what he said to you earlier, of course, is that they haven't really seen that happen as much as they hoped. And that's also a big part of this business, but also a broader issue for chip makers, chip makers that are dependent on the consumer markets as well. That's a real concern. So Infineon's focus on autos has really been able to help them.
Really important context, great analysis. Thank you, Bloomberg's Aggie Cantrell, on those Infineon results. Coming up, European stocks are cheering the softer US CPI print. Of course, we're going to discuss if the risk rally really has legs, though. Is it here to stay? That is next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, You interact with the crew and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome back. This is Markets Today. We are 53 minutes into our trading day. European stocks going higher once again after yesterday's excitement, continuing that theme. Let's talk about what's happening in these markets. Ven Ram joins us from our Markets Live team. Let me start on the UK CPI picture, Ven, because we had that out this morning, and it showed that inflation is falling faster than expected. The government takes a victory lap because it did manage to halve it, but it's not back to target. What are your calls on UK assets as a result?
I think that the victory lap is a bit premature and over-enthusiastic, because if you look at retail price inflation, that's still hovering around 7%, not the 2% that the Bank of England wants. So to call it a victory is a bit premature. But having said that, if you look at gilts, they are not rallying a whole lot despite the softer than inflation data print, and that kind of shows the market's mood that, look, are we getting ahead of ourselves in kind of pricing too much policy loosening from the BOE eventually down the line?
Ben, what about the pricing around US then, given what we saw, the yield action yesterday, with double-digit moves lower across the curve, or at least at the front end of the curve? The 5-year certainly saw that. The dollar falling to the weakest level in about a year. Are markets getting ahead of themselves there in terms of pricing in cuts for next year?
I think so, Tom, because if you look at the market follow-through reaction today, that's more telling than what happened yesterday. There's not been much of a meaningful follow-through. And that kind of suggests that what happened yesterday was more about short covering of positions, whether it is in the euro or whether it was in the pound or in treasuries. So it would be foolhardy to read too much into those moves. I think a lot of banks are calling for very drastic cuts from the Fed next year. I don't think that's going to pan out. I think that looks a bit over the top, because the bar for the Fed to kind of come out and say, look, we need to accommodate the economy rather than keep rates at restrictive levels is pretty high. For them to go out and cut rates to levels that some are expecting as much as 275 basis points of cut next year, I don't think that's going to pan out.
Okay, thanks so much, Ven. Good to get your perspective. Ven Ram from our Markets Live team. Remember, you can get up-to-date analysis and insight from Ven Ram, from Eddie van der Veld, from Mark Cudmore. MLIV Go is the function to use on the Bloomberg terminal. That's where you'll find the Markets Live blog. Tommy was referring to UBS and Morgan Stanley, of course, who have these aggressive views, pricing in much more cutting from the Fed than the market. Yeah,
UBS having a call that they're going to cut rates down to 2.75%. So 275 basis points of cuts being forecast by UBS. Ven Ram pushing back on that. That is it for Markets Today. Get more insights across from us and the team on the front page of the website. European equities adding to gains, currently up 0.6%. This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Investors welcome cooler than expected inflation readings in the U.S. and the U.K. as evidence central banks may be done with aggressive rate hikes. Well, stocks rise, the dollar and pound fall. Siemens Energy sees a return to profit in 2024 after government intervention, but Alstom tumbles after the train maker said it's cutting jobs and selling assets to shore up balance sheets. Plus, China's President Xi arrives in the U.S. ahead of high-stakes talks with President Biden, while back home, Beijing pumps more cash into the banking system. So first thing is first, let's take a look at what the markets are telling us. This is the European markets map. The figure, or the one thing that we need to watch out for is, of course, dollar, what it's done so far. But it's very clear that we're not only getting the, I guess, not fallout, but the continuation of some of the stock rally that we saw because of the rate relief wager that the Fed is pretty much done hiking. The pound, though, slipping after that UK inflation slowed more than economists had forecast, a similar outcome to Tuesday's readings of U.S. prices. So let's get back to inflation. Again, UK inflation down to the lowest level in 2 years, bringing relief to consumers. Year-on-year CPI rising 4.6% in October, the lowest pace in 2 years. Now, this comes as a U.S. inflation print also showed a broad slowing yesterday, investors speculating that the Fed is done with its aggressive rate hiking cycle. Well, here with us, Skylar Montgomery-Koenig, head of macro strategy at TS Lombard. Skylar, thank you for joining us. When you look at that inflation print in the U.S., we also spoke to Jamie Dimon of JP Morgan, and he says, look, not that quickly. It's very difficult to see inflation, or he's not as optimistic that inflation will continue going down from now. What's your take on U.S. inflation?
Yeah, I mean, for the U.S., we are seeing disinflation, certainly. So headline inflation peaked all the way back in last summer, and core a few months later. And since then, there has been this clear downtrend. You know, base effects are less favorable at some points. I think that's well understood by consensus. We also know that when inflation is higher, it's more volatile. And you can see that clearly in the impact in geopolitics, right? As commodity prices go up and down. And that feeds into headline inflation automatically and core through the impact it has on it. So we will get inflation prints that are a bit hot. And core definitely is still too elevated for the Fed's comfort, but the trend is still in the right direction. And I think that's the key for the market, and that's what we saw yesterday. So we think this disinflation story has legs into the end of the year, and that markets can look through small upside surprises when they do come.
Okay, so Skylar, I was telling you about JP Morgan Chief Executive Jamie Dimon. Here he is.
They're doing the right thing to pause for now. They've raised rates a lot, to wait to see the effect on the economy in the U.S., particularly as the fiscal spending, the excess fiscal spending is winding down and quantitative tightening is kicking in. But I still think you should prepare. They might have to do a little bit more. And I think people should be prepared for that just as a kind of a risk management tool. And I'm afraid inflation may not go away that quickly.
Okay. And well, also 3 months ago, Fitch Ratings downgraded U.S. credit rating, and this weekend we saw Moody's changing its outlook on the U.S. credit rating to negative, pointing to a sharp rise in debt servicing costs and political polarization. What do you expect in these terms?
I find it a little ironic that Fitch and Moody's are doing that today. So here's what I think. They are right to point out those issues. I would take polarization off. That's always been true in a democracy. But yes, we have far more debt and more debt financing. We've been a little profligate when it comes to that. But the market is pricing us as AAA, which I think is more right, and the market will be more right than the rating agencies. I also want to point out, I find this almost funny, they have a lot of countries rated AAA. They all live under the protection of the American military. And so I think it's a little peculiar that makes them AAA, but not America. So America will be fine, but we got to get our hands around these problems. They will not age well. The deficit's a lot bigger this year than we thought. There may be consequences of that. And so I think they're right to point it out.
Well, that was the JP Morgan Chief Executive Officer, Jamie Dimon, speaking exclusively with our affiliate El Financiero, Bloomberg in Mexico. So let's also bring in Eddie van der Walt from our Bloomberg Markets live team. Eddie, when you look at Fed swaps, they're definitely indicating the odds for another hike have fallen to almost zero. The market actually pricing in now a 50 basis point rate hike by July, rate cut by July. Are we actually crying victory before we're really seeing the whites of inflation going down?
You know what, Francine, I looked at those numbers yesterday. Inflation came in 10 basis points below expectations, right? Core came in just below expectations. And the market reaction was huge. I think what was happening was that two things simultaneously. As you point out, the odds of a rate hike has completely disappeared. The market is just not expecting a hike. At the same time, at the margin, some people added to the expectations of a rate cut next year or more rate cuts next year. So you had this pricing out of the hike and a small pricing in of some cuts. And that just amplified the downside moves in yields. And so we saw, I think it's not a normal distribution of moves that we saw. It's almost a log normal distribution that you saw. And it very heavily skewed the market's reaction. But I think what happened yesterday is we're probably much more headed towards a soft landing type of outcome. But very interesting to see just how much the market moved on those moves.
Skylar, give me a sense of how you build, and you're looking at all asset classes. So how do you build an ideal portfolio? Like how much commodities versus, equity or fixed income?
Yeah, I mean, I'll say right now that we very much view macro fundamentals as being solid, right? So the disinflation trend, as I said, should continue into 2024. Data surprises in the U.S. are strongly positive. A soft landing looks increasingly likely, and you look to be finding more of a floor in Europe and China, as well as if you look to central banks, they're clearly heading for the pause stage. They're waiting for inflation to come through and for that tightening to feed into the economy. So for us, that means that we're relatively risk positive. I think the other big thing to highlight is the divergence in growth between U.S. and Europe. So for us, we think this U.S. exceptionalism will continue into next year. So while we're more positive on risk, we are more positive on U.S. than European risk. I think the other thing to highlight is that with yields, at current levels, that is a good risk reward in terms of the income is quite good as you head into next year. And especially at the front end, where the Fed has somewhat limited how high you can go in yields on the front end, certainly, there's good risk reward there. And so I think actually it's a pretty good investing environment overall.
So Skylar, are there points where you actually want to enter the market? Or again, is it a little bit of a wait and see? Because it does also seem quite bifurcating, all about inflation.
Yeah, absolutely. I mean, so we've obviously had a big move yesterday. You've seen kind of overreactions, especially, I think, when you look to FX. The dollar moved strongly, and I think that's largely a reflection of positioning being very overbought dollars. In equities as well, we've seen a large move, and so potentially you want to look for opportunities to buy those dips. But I think especially heading into 2024, people are unsure about, in the same way heading into 2023, people thought there was going to be a recession and then it never occurred. Right now, we're unsure of whether or not there's going to be a recession in 2024, and that leaves some room to rally into the end of the year. And so I think a lot of people are thinking that they don't want to miss that rally, especially if they've got cash sitting on the side.
Eddie, what else are you watching? We know that the meeting between Presidents Xi and Biden are extremely important to see whether some of, the very tense relationship, whether that thaws away. Could potentially that be a market-moving event?
Yeah, I think Skylar is exactly right. I think the market right now, I think a lot of traders will be thinking about, positioning into year-end and then positioning into next year. And I think, that China-US relationship that you're alluding to, that becomes more and more important as we move into 2024, we get closer to that US election. I think, next year is going to be a big political year. We're going to have the US, we're going to have the UK, elections likely. And I think that's probably going to define market trading a lot, because you are going to talk about the geopolitics, you are going to talk about different things, but at the same time, Skylar also mentioned the short end of the curve. I think the degree of steepening and just where that steepening comes from in the yield curve, I think those are the two main themes for me. And I think there is probably much more steepening to come. Because at some point, if this market is pricing not a US recession next year, if the market is saying, it's possible, but it's no longer likely, then you're going to have to see longer end yields, pushing above and disinverting the curve a little bit more.
Thank you both, of course, for joining us. Eddie van der Walt, of course, from Bloomberg MLive team, Skylar Montgomery-Koning, head of macro strategy at T. It has struck the economy. So at the moment, this just broke seconds ago. The challenge was filed by lawmakers from the main opposition Conservative Alliance, who said they wanted to ensure that the sustainability of the country's public finance continues. So for the moment, the Federal Constitutional Court has ruled that the shifting of the 60 billion euros earmarked to tackle the pandemic into a one-off budget fund violated German constitutional law. I don't think it's the only challenge that we'll see out there in some of the funds that then have been transferred to other parts of the economy. An extremely important ruling from Germany's top court. You can see euro-dollar 108.63. Coming up, another cash injection for China's banking sector, but better than expected retail sales also give the economy a boost. We'll have a full roundup of that next, and this is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The United States imports circa $500 billion of goods from China a year. Our economies are incredibly coupled together, and an abrupt decoupling would come at just catastrophic costs to the people of both countries.
Well, that was the Citadel Chief Executive Officer, Ken Griffin, speaking exclusively to Bloomberg at the Citadel Securities Global Macro Conference in Miami. That interview done by Arshanali Bazak. Now, China has stepped up its efforts for its economy by pumping the most cash into the banking system since 2016. We've also had consumer spending data out of China, which show retail sales rose some 7.6% in October compared with a year ago. Let's bring in Bloomberg's Jill Desis in Hong Kong. Jill, great to have you on the program today. Now, another cash injection was on the cards, but this is actually bigger than expected.
Yes, Francine, it really is. I think that at this point, what you're seeing happen with the People's Bank of China here is that they're offering more liquidity. They're trying to help the banking system a bit. We actually think this is about equivalent to a decently sized cut to the reserve requirement ratios, the amount of cash that banks have to keep in reserve. And so what this should ultimately do from a monetary policy perspective is actually help the PBOC, avoid trying to, trim rates, at least within the next couple of months. That should help them continue to support the economy from a monetary policy side in some respect without cutting rates, which could actually weigh on profit margins for banks if they cut a bit too deeply. So I think that that's why you're seeing this larger than expected net injection today.
But at the same time, Jill, I guess retail spending was stronger than expected. That's the flip side.
Yes. So the data today, the economic data today that we got out of China was pretty interesting. You did see that bigger than expected jump in retail sales, 7.6% year on year. The thing that I want to caution with that data, though, Francine, is that it does compare to a pretty low base from October 2022. Remember, that was when China was still observing quite a lot of pandemic-related restrictions, lockdowns, and there was also rising COVID outbreaks in the country. And so the thing that we have to be really careful about when it comes to this economic data today is that even if those numbers are pretty strong, the base of comparison is so favorable this year. I do want to point to some mixed data elsewhere within the set that we received today. You look at fixed asset investment, for example, which actually came in a bit under what we thought it was going to. That's in large part due to this pullback even more in property development investment that was, I think, decelerated more than we expected. So some positive signs there for the economy, but there's still a lot of work to go when it comes to China.
Jill, as always, thank you so much for a great analysis and roundup of the main news out of China, our Jill Desis. Now, let's get back to Skylar Montgomery-Koenig, head of macro strategist at TS Lombard. Skylar, I don't know, again, we were talking actually about whether the fact that President Xi and President Biden are meeting could be market moving, but certainly as long as things don't escalate, that's a positive for the economy and therefore markets.
Yeah, absolutely. I mean, I think because tensions had gotten so high, there was quite a lot priced in negatively. For China in particular, what you've seen is, we actually reopened a year ago, if not more, and people got excited more than a year ago over Chinese stimulus feeding into asset prices and feeding into the economy strongly. And we're still getting this kind of drip feed in stimulus that's not actually making a huge impact because we're not doing the same kind of supersized stimulus and infrastructure-driven stimulus. It's consumer-driven stimulus. So it's a very different environment than the rebounds we've seen previously. And so it's in China's interest now as well to have better relations with the U.S. because they need that bottoming in data, which will likely come through this quarter. But for them, it's also in their interest to have a more positive relationship with the U.S. and to see that feed into markets as well as into their growth outlook.
Skylar, is there something else actually that you look in terms of, if you look at the macroeconomic trends we've touched on, you look at fundamental analysis, but what have you seen in earnings that could be a little bit off because of everything else that's going on?
Yeah, I mean, the U.S. earnings season was actually quite strong. For us, corporate fundamentals, they look to be bottoming. We had 3 quarters of negative earnings, and we're now out of the earnings recession. So since 2021, margins have been kind of rising and falling with inflation. So first we got margin expansion because demand-driven inflation, and then margin-driven inflation. Then consumers pushed back on continued price rises, and margins fell. But following 5 quarters of steady decline, margins are stabilizing now. And the good news is that they are stabilizing at still very healthy levels. So U.S. margins are at the high end of the previous range. Sales and earnings surprise has also been positive, but it hasn't actually spurred price gains. What we've seen is more reaction to the macro, and that's because this positive surprise has been accompanied by negative guidance, in particular worry over weak consumer demand. And so again, it points to the macro being a large driver, regardless of what's happening with earnings.
Yeah, and in your actually data points, you say the U.S. earnings recession is over. Skylar, thank you so much. You'll have to come back because we have plenty more to talk about. Skylar Montgomery-Koning, head of macro strategist at TS Lombard. Now, one other stock that we're watching out for is JD.com, rising some 5.6%. This comes as third quarter net revenue actually beat estimates. So we'll have a full roundup of the main stocks to watch next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
On the next episode of the Business Week Show.
Reputation. People say, well, LeBron gave you an opportunity, lucky you did this. But you don't talk about Donald Trump's dad gave him a loan, James Dolan's dad gave him a business. What's the difference?
I try not to care too much about what people think, and if that helps others see that there's more to life than a good reputation, that can be a positive step.
Watch the Business Week Show Thursday nights, 10:30 Eastern on Bloomberg Television or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
Now, Germany's top court has struck down a key element of the government's funding plans to address climate change and transform the economy. Well, Bloomberg's Oliver Crook joins us now with the very latest. Ollie, good morning. This feels significant because basically they took an issue with some of the money that was transferred for COVID and transferred into underfunds. What does that mean going forward?
Exactly. We got to do a little bit of a history lesson here. So basically there was this money that was approved to use for COVID emergency spending. Some of that money was left over, 60 billion euros, which is not an insignificant sum. And that was transferred from the Schultz government from that emergency COVID fund, which was not used, into this climate transition fund. And basically that relied on the argument that this was going to help stimulate the economy and obviously help kind of the broader German economy, and therefore sort of worked under the umbrella of this emergency funding. And the CDU, the opposition, the conservatives, the fiscal hawks challenged us. They brought it to court. About a year ago, the court ruled in favor of the government, which is why this is such a surprise, with now the court finally ruling that this does not actually work, that the preliminary ruling did support the government. This does not. This is kind of an unexpected outcome. They were saying that the Supplementary Budget Act of 2021 does not meet the constitutional requirements for emergency borrowing, and that the law violates the budgetary measure, and that it is incompatible and void. So this, in terms of the broader ramifications that this could have for Germany, this comes at a time when the coalition here is very, very, there's a lot of arguing within it. There is the AfD, the far right, that has risen precipitously. This is really a blow to the Schultz government, and it's just, and we expect to hear from them a little bit later today, probably from the Chancellery. But again, this is just primarily, we're going to have to go through some of the details of what this actually means, what happens to this money, but it's a real blow to the Schultz government, and that is certainly an indisputable takeaway from this.
So, Ollie, what I'm trying to figure out is that, does it actually mean that they need to spend less, or is it is it like a legal problem and how they went around it, or is it now the Constitutional Court saying, actually, we worry about the deficit, you can't spend this much?
Well, the question is, what happens to the 60 billion euros now, right? So this was sort of outside of the normal sort of budget because it was transferred from this emergency fund. And I think that this now hangs in the limbo, and we're still getting headlines because they're literally reading the verdict of this over the last few minutes. So there's going to be a bit of nitty-gritty, as you know is the case often with sort of German fiscal efforts. But I think that really the question is going to be what happens to the 60 billion euros. And again, the budget is back in focus, particularly in the wake of all these emergency actions that the government has taken over the last few years, from the pandemic to the emergency, of the energy crisis. All of these things are now coming to the fore.
Ollie, thank you so much. Oliver Crook there in Berlin with the very latest, of course, on the Constitutional Court in Germany. Now, coming up, we'll be speaking to Sandro Pieri, Chief Executive Officer at BNP Paribas Asset Management, about his outlook for the European economy. We'll talk markets. We'll talk, of course, some of the fees also surrounding the asset managers and some of the risks and rewards. That coming up shortly. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Investors welcome cooler than expected inflation readings in the US and the UK as evidence that central banks may be done with aggressive rate hikes. Stocks rise, the dollar and pound fall. Germany's top court has struck down a key element of the government's funding plans to address climate change and transform the economy, dealing Chancellor Olaf Scholz's coalition a major setback. Siemens Energy sees a return to profit in 2024 after a government intervention, but Alstom tumbles after the train maker said it's cutting jobs and selling assets to shore up its balance sheet. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, U.S. inflation broadly slowing in October, indicating that the Fed may finally be done with hiking rates. Markets now put the chance of another Fed hike at almost zero, while pricing in 50 basis points of cuts by July. Well, joining us now is Sandro Pieri, I'm going to say it the Italian way, Chief Executive Officer of BNP Paribas Asset Management. Sandro, as always, thank you for giving Bloomberg a little bit of time. I know you're very generous and you're trying to explain, first of all, the kind of markets that we have now and what we'll be left with. What's the question you get asked most day in, day out? Is it inflation and central banks?
Well, first of all, thanks for having me here. Look, we got asked many questions. I would say probably the most frequent one are inflation and unemployment. I mean, while I think inflation is slowly coming down, and I think the numbers yesterday is clearly confirming the thesis that inflation is a bit more under control. What is a bit striking is the resilience and the strength of labor market on both sides of the ocean, which is the other element that would give us comfort in believing that as we go in 2024, markets will buy more aggressively into basically reversal of central banks tightening. There's a number of structural reasons probably for labor market. To us, probably the best explanation is that given the shortage in labor market that many firms have seen after pandemic, they're very, very cautious in taking more radical action because they know that it's going to be very tough to rehire when the economy will restart. So unemployment, inflation, probably the most tricky question at this stage, and I think the rally yesterday is quite meaningful because I think it signals that there's appetite for risky assets the moment there's a clear outlook. Now, having said that, I think is definitely the numbers yesterday is a bit better. But our view is that central banks will err on the safe side, meaning that until they will have really significant confirmation that inflation is under control, they will not start easing. So it might take a bit longer than market is discounting right now.
I'm really happy you came in today because I feel like we have everything. So we have the U.S. inflation number in the U.S., the rally that you were talking about. We also have President Xi and Biden meeting, and it seems that markets have largely discounted or not really focused on geopolitics. Again, is there a worry that markets are looking at the wrong things, and that actually they don't even know how to price stagflation, which is what you're potentially hinting at if the labor market stays strong?
Well, look, it's a very difficult market to navigate cyclically, but I would say even more structurally. One of the theses we have been putting in the world with our clients is that we're living in a world of what we call four multiple transition. So everyone has been focusing really on the ecological transition and energy transition. But at the same time, we're seeing a technological transition, we're seeing a demographic transition, and we're seeing a geopolitical transition. And they're all happening at the same time, which is quite unprecedented. Like in my professional career, this is the first time that such a big change is happening. And it's structural in nature. These four major forces are self-reinforcing in a way, but potentially also contradicting each other. And there's a couple of implications for that. I think longer term, and that's where the market is struggling to price properly, is we believe that this is pointing to structurally lower GDP growth globally and higher inflation. And this is almost like a paradigm shift compared to the last 20, 25 years. So in a way, we are in a regime change, which is very difficult for market to price because we normally look at what has happened in the past. So that's exactly where we are right now.
And I guess underpinning everything is the cost of money, right? The cost of credit. And again, how much of that is structural given the shifts, the four shifts that you were talking about it?
Well, look, if we're right in saying that inflation will be structurally higher, like not dramatically higher, but probably averaging the 3%, of course, the floor in interest rates will be significantly higher than the one that we have seen in the previous cycle. So the zero interest rate, probably we're not going to see it for quite some time. So there's a structural element also in interest rates. And by the way, slightly higher interest rates are not bad necessarily. What I think has really hurt the economy, the system, is the speed at which rates have risen over the last 2.5 years. Not necessarily the absolute level, but the speed has been really significant.
Sandro, we also had the governor of Banco de Portugal a short while ago here, and this is what he had to say on European growth.
Are data dependent, and these data really are good. They show that inflation globally is falling. The same thing is true for the Eurozone. We got a number for October that is already below 3%. We must be patient, but yes, we have this feeling that we are doing our job.
I mean, he was talking about anxiety, right, over a soft landing. What kind of questions do your clients want from you? Does it feel good actually being in charge of an asset manager right now, or is it getting a crowded space?
Look, as a business, I think we're also going through significant transition. I mean, it's been a great business to be in over the last 20 years, top-line growth, margin expansion, and driven by structural forces. I mean, the reality is that today, even in Europe, only 1/3 of households have their assets and savings professionally managed, and this will continue. So I think we continue to be in a growth mode, but the other driver for us has been market performance, because our asset base goes up and down with market, and structurally over the last 15 years we've seen assets going down because of market performance. I think the next year will be a bit more challenging because probably we have a view that actually expected equity return will be subdued somewhat relative to what we have seen in the past. And that will have an impact on the structure of our industry. And everyone is discussing about, pressures on cost. We'll have pressures on the top line as well. So it's a bit of a reversal of the previous long cycle that we've seen in asset management. But I think it's crucially important that we reestablish our role also from a policy-making perspective. We're a key mechanism in reallocating capital. And I think one of the structural debate that we're having with policymaker and regulator is how we can support, on one side, this big transition that I've just made reference to, and make sure that we support the reallocation of capital for energy transition, for example. So I think we're playing an important role. I think it needs to come with an increased retail participation in capital markets, which is something that I think we started to see happening, but it's still too low.
But given where we are now, and I'm not speaking about BNP Paribas Asset Management in general, do you think that the flow of capital is going to where it should be, given the shift also for the green transition, or is there still a lot of work to be done?
Look, it started to go in the direction that policymakers has identified. I think if we look at the flows in sustainable related product, Article 8, 9, I don't want to go too much into the technicalities. Over the last 2.5, 3 years, we definitely have seen this product attracting more flows than all other products. So this is happening. I think also the tilt that we're seeing on sustainability on the private asset side is clearly going in the right direction. Now, having said that, the challenges for supporting the net zero transition is just huge. I mean, it's an additional $3.5 trillion per year to support net zero transition. And so it's not enough. I mean, we're just at the beginning. And of course, there's an element of expected return. We have seen a bit of pressures over the last few months of on performance of product which are a bit more sustainable. Look, this is a cyclical business, so we'll see it more and more going in waves. But we're just at the beginning, and I think we need to accelerate because the reality is that the pace at which, especially in Europe, we have deployed renewable sources is not enough to be consistent with our 1.5 degree pathways. So we need to accelerate now.
Sandro, thank you so much. Don't go anywhere because we'll continue the conversation. Sandro Pieri, the Chief Executive Officer of BNP Paribas Asset Management, stays with us. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction or they invest for if they invest for the right reasons, just keep at it.
Earnings season is here.
Tons going on, lots of earnings. Beat, wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money. You're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
Welcome back. Now we are just getting some breaking news on the Bloomberg terminal. This is the EU taking aim at some of the key machine exports to Russia in some new sanctions. So this is, for the moment, a proposed ban on the export of machine tools and machinery parts that Russia uses to make weapons targeting Ukraine. Now this is according to EU documents that Bloomberg have seen. I imagine that the main focus on the new sanctions package is actually to try and further crack down on the Kremlin's ability to circumvent EU sanctions and feed its war machine. Now, yesterday we also had a very robust conversation with Torre Bolzoni of the IEA, and when you look also at oil outflows, in many cases it feels like Russia has been able, if not circumventing some of the sanctions, certainly they haven't been hit by the oil sanctions as much as the West would have thought it will. So we'll see exactly where this ends. I imagine also by taking aim at some of these machine exports to Russia, it could actually curtail Moscow's source of revenue. So we'll keep an eye on this to give you any more breaking news on that. Maybe also look at some of the companies that are doing some of these machineries. But let's go back to talk about asset management, fees, some of the challenges going forward, and some of the main opportunities. I'm delighted to still be joined by Sandro Pieri, the Chief Executive Officer at BNP Paribas Asset Management. Sandro, thank you for joining us. We were talking a bit about markets, client behavior. We were talking about the reality of stagflation, and you very clearly and beautifully put the fact that we're going through a massive transition, that there are 4 parts of the transition, and we don't exactly know where we end up. What does it mean for asset managers?
Well, for our industry, again, we will have to cope with possibly lower growth and probably subdued equity returns, which clearly is an important determinant of our revenue growth. On the flip side, we're definitely going to see a revival of fixed income. I mean, with rates, long rates and short rates being that high on both sides of the ocean, I think that creates clearly opportunities. And I think we start to see money flowing into fixed income product from probably September onwards. And, you know, the value proposition is reasonably simple. You might lock in for 5-10 years, anywhere between 4.5% to 5%, which actually is a great stabilizer of your portfolio return.
Sandro, is the 60-40 portfolio dead? I've been asking this for the last, I feel like
definitely
it's
last
been a
year was
decade.
dead. Definitely last year was dead, and clearly, I mean, we have done a lot of research like everyone else. It shows that actually the benefit of diversification of bonds was no longer there because bonds moved, they were completely correlated with equities, which is normally doesn't happen, and that's the reason of the diversification of portfolio. Now, probably the way the 60-40 portfolio has been thought through over the last decade is over, but the need of having a diversified approach to your investment is key. And I think what has changed compared to last year is that the base rate, the base level of yield is clearly higher. So your starting point is 4.5%. You have a carry that will be used as a buffer to offsetting the volatility in bond prices. So I think our view at this stage is that bond will definitely provide, again, diversification and protection in an environment which is going to be very volatile.
I mean, you're the chief executive of a very sizable asset manager. What does AI mean for how you service your client? Is it something that you spend a lot of time on, or do you spend more time really trying to figure out where capital flow goes to in the transition?
No, we spend time on everything that we think is going to be strategically significant. But I would say that AI, I think, is very early days, not only in our industry, although we start to see some meaningful impact. But I think we're focusing right now on AI in everything that is has a potential to generate efficiency and automation. There's you know, the number of use cases that the team has brought up is just huge, and we need to prioritize, we need to test. And there's another element which is important. Everyone is talking about AI. The reality is that if you don't have your data set in orders, there's not a lot that you can do with AI because it's about accessing data. And there's probably a bit of catch-up that needs to be done there. So we're looking at it. We are starting to frame our journey towards using increasingly AI. But at the same time, I mean, what keeps us busy now is trying to understand whether we have the right product offer for a cycle which is going to be very different in a way.
Talk to me about, I mean, asset management is a crowded space. How do European asset managers compare with US ones or Asian ones? The brands feel very strong. Do you get that? Does it translate into revenue?
Look, overall, I would say the European asset managers are doing quite well. I think they've benefited from the brand of UCITS, which is the vehicle that has proven to be a pretty effective vehicle to protect investors and with a very good regulatory framework. And I think UCITS is now being recognized as a brand not only in Europe but also outside Europe. There's a difference, which is a structural difference between US and Europe from an asset management perspective. The first one is that US asset manager, their home market is the largest market in the world and is one single market. For European asset manager, even if European Union Capital Market Union, but doing business in different countries is not exactly the same thing. So the level of economies of scale is completely different. And the second major difference is that U.S. asset management industry has grown because of a significant tax incentive when it comes to long-term savings, the 401k plan, which I think is still missing in Europe. So structurally, these are, I would say, the two main differences. But the human capital in Europe is now absolutely great, and I think we feel we can absolutely compete with some of the largest players, and we'll see growth.
So interesting. Sandro, thank you so much for joining us today. Sandro Pieri, BNP Paribas Asset Management Chief Executive Officer. Now, European Central Bank Governing Council member Mario Centeno also says there are concerns over the euro area economy, whether it will have a soft landing following a lack of growth in recent quarters. Well, Centeno spoke exclusively to Tom and Anna.
The numbers have not been great. 0, 0.1, minus 0.1 quarter on quarter for 5 quarters in a row creates a little bit of anxiety over will this be a soft landing? This stagnation of the euro area is, of course, a source of concern for all. It will help bringing inflation down, that's for sure. Of course, monetary policy sometimes also has this side effect, which is the main channel, actually, of our transmission to the economy of our decisions. We just need to follow on the data. Again, the labor market is the pillar. It works pretty much as a dam to protect workers, firms, but it is a derived demand. It is the result of the economy, so we need to follow it very closely.
On the emergency program, the PEP program, so the Pandemic Emergency Purchase Program, and the reinvestments, so the ECB has signaled that reinvestment will continue until the end of 2024. Is that time frame still appropriate?
One of the greatest successes of this cycle of monetary policy hiking in the Eurozone this time was our ability to keep financial stability, which is a precondition to price stability. It didn't happen in the previous hiking experiences, but this time we've been quite successful. So anything that we do that is not focused entirely on price stability, keeping financial stability will not be on our menu, but we need to reduce the balance sheet. We know that, and we will do it, but always having in mind this prerequisite of keeping financial stability.
Well, European Central Bank Governing Council member and Portugal's Central Bank Governor Mario Centeno there. Coming up, President Biden is sent to meet China's President Xi Jinping in San Francisco. So we'll look at the challenges facing both leaders. That's next, and this is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Now, the Chinese President Xi Jinping has arrived in San Francisco for a high-stakes meeting with his American counterpart, President Biden. Their talks on the sideline of the Asia-Pacific Economic Cooperation Summit comes as China seeks to boost confidence in its slowing economy. Now, here for more is Bloomberg's EMEA news director, Ross Matheson. Ross, I think they're also gathering among like 16 acres of lush autumnal garden, so maybe they'll go quietly at the back to try and find a deal like we've heard whispered of former presidents. Yesterday, we were talking about what they each need from each other, but what's considered a success, actually?
Well, beyond the meeting itself, which of course, is a reset after they met about a year ago in Bali for 3 hours, and we seem to be on the runway for that breakthrough, and then of course it went downhill for a while. So we're back there at that point, right? So they have a meeting in San Francisco late today. It could go for several hours. It's a bit of a reset again, a bit of clearing of the air, mutual interests on either side for that. But then what happens after that? The expectation is we'll get announcements about continued lines of communication, and we're going to have this group that will be talking about things like military affairs going forward. These group of officials will be talking about things like AI and so on. So there'll be announcements about a whole series of of lines of communication that will remain open after this conversation. That will be the most immediate tangible that will come from today.
But overall, is this about the economy or is this about the military?
It's really about interests for both. It is for Xi Jinping about the economy. As you were saying, his economy is struggling and he needs to get it back on a better footing. He needs markets to settle down. There's a lot of imagery already. So he's turning up with a bunch of Chinese journalists with every move, a big crowd at the airport last night. So that's all beaming back into China, showing him doing what's needed to betray China's interests on the global stage and to help the economy. So that's good for him. I mean, that's really the impetus. And of course, for Joe Biden also, he has economic imperatives. We've got China buying soybeans again. We've got China perhaps welcoming US business back in. That's all good news for Joe Biden. So right now we've got a win-win in a way of interest for both of them. The question is, how long can it last?
Yeah, and back home, do they both need to be quite tough on the other one, actually, for appearances?
Well, that's, again, how it's all portrayed. For Joe Biden, he does have a need to have a thaw with Xi Jinping for now, but he's coming into election late next year, and he can't do things. It's quite difficult, for example, to dismantle all the architecture around tariffs that were put on China, because he does still need to be seen to be protecting US business, supporting US business. So there's only so far he can go, and he's taken quite a tough stance on China so far. The mood in Washington generally, politically, is to harden on China. So he doesn't have that much manoeuvring room. So for him, it's about messaging at home. For Xi Jinping, it's about showing up, showing he's very present on the global stage, is being received by the US president very much as an equal leader, as an equal partner in global affairs. But again, it'll be about the way that message reflects back home.
Ross, thank you so much. As always, Ross and Matheson, they're on the latest with that President Xi and President Biden meeting. Now, coming up on Bloomberg Surveillance, we'll also be speaking to the EU Economy Commissioner, Paolo Gentiloni, 12:40 UK time. From a mining company, which frankly is dirty, it's big, now you want to reposition the company into a green energy powerhouse. Are you a walking contradiction, or what did you learn along the way?
Well, in the early days, it was considered completely impossible for anyone. Doesn't matter if you're a huge company, like back then it was Anglo-American tried to break into the iron ore industry, and they spectacularly failed, even though that back then they were the largest mining company in the world. Now, for an upstart, a tiny little company with next to no cash at bank, no ground, no anything, for them to announce that they were going to break into the iron ore industry, the global seaborne iron industry, probably the most protected, viciously protected resources industry in the world, and then take them on head on, it was just considered impossible. It was just like a fairy tale. However, we stuck to the plan. We always tested each other by making sure that we were starting where we wanted to finish, which is as a major iron ore producer. And then we took all the steps back. We calculated what the steps would be, even though some of them seemed impossible. Now we have a strategy, and we've got to go flesh that strategy out and pursue it with single-minded focus.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Stocks surge, yields plunge as U.S. CPI data stirs the hopes that the Fed hikes are over. But Ken Griffin and Jamie Dimon are warning red flags.
But I still think you should prepare. They might have to do a little bit more. And I think people should be prepared for that, just as a kind of a risk management tool. And I'm afraid inflation may not go away that quickly.
China Xi arrives in the U.S. ahead of high-stakes talks with President Biden. Military communications, export controls, and fentanyl top the agenda. Barry Betts, the money manager, is once again long Chinese e-commerce giants Alibaba and JD.com after giving up on them just a few months ago. A very good morning. Let me just show you what the makings of a hard pivot might look like. This is the U.S. Treasury market. It was a collapse yesterday of over 20 basis points on the 10-year paper. We're back in the green for U.S. Treasuries for 2023. For U.S. Treasuries, we're back in the green. Global treasuries are perhaps clawing their way back to the green. That is the manifestation of lower CPI. And again, where do you want to hide? The shorter end of the curve, that is the question. Bonds, I mean, it was a seismic day for treasuries. Did the higher for longer just get slayed? That's the question that goes through my mind. Small reprieve this morning after a 20 basis points move yesterday. From the US to the UK, the UK 4.6% this morning on their inflation data. That's the lowest since 2021. The market is now baying for 50 basis points of cuts in the US by July 2023. So are we moving to a hard pivot? Certainly, there's a warning sign from Ken Griffin. It says the Fed's credibility is there. It's at risk if they shift on rate cuts too soon, on rate hikes, I should say, rate cuts too soon. Cable is down. It did have a monster move by 1.75% yesterday. So we saw quite a magnificent move, drop in the dollar and a rise in sterling, a rise in the euro dollar. So you are just looking at the cable this morning at 124.65. Again, the market pricing in 78 basis points of cuts by the end of next year. Iron ore, I thought we'd give you a little soupçon of the commodities. You've got this China stimulus story out there. We've hit $130 for the first time since March, just backing off from there. We've got $137 billion going into the housing sector. So stimulus abound.
And the euphoria is still alive and well, whether you're looking in Asia stocks or U.S. stocks too, Manus. They're taking heart from the cuts priced in the market, but how long can that last? Gains continue this morning, up at least 0.2% for the S&P and Russell. Now, if you look at the contours of what rallied yesterday, it was really led by the most short stocks. The most short stocks, a Goldman Sachs basket of that, rallied 7% yesterday. That was its best day since November of 2022. Also, the best day for the Russell 2000. This thing rallied more than 5% yesterday. Small cap stocks have been beaten up. They come back alive with some serious force yesterday. And again, the gains continue today. Now, Asia Pacific needs to play catch up with the U.S., so it's up 2%, 2.3%. But Manus, it's also getting a boost from that stimulus, that China stimulus that you mentioned. The question will be, how long can this continue? How long can the euphoria filter through both stocks and bonds, which I should say we're in the midst of the best 3-week gain for stocks and bonds so far this year. Perhaps the Fed officials come to spoil the party, Manus. And what we've already heard from both Goolsbee and Barkin yesterday fight against that proclivity to price in that euphoria. Barkin said not convinced that inflation is on some smooth glide path to 2%. Goolsbee, for his part, said progress continues, though we still have a way to go.
Well, of course, there's words of caution. Ken Griffin, as I said to you, said he's at Citadel. More from Shanali and her conversation with him later on. The Fed's credibility is at risk if they cut too soon. The market's giving 50 basis points. You know, the question is this, is Jamie Dimon right? It might not go away just so quickly. And of course, we have the other dynamic, which is, are we seeing 1995, a 1995 redux? But we'll talk more about that in a moment with our guest host. We have this slowdown, Danny, inflation. It's boosting the bets that the Fed is done. Citadel CEO Ken Griffin, I've just mentioned him, spoke exclusively to Bloomberg that to go too quickly could be a mistake.
The Fed needs to stay on message that they're going to put the inflation genie back in the bottle. And so if they cut too soon, I think they risk losing credibility around their commitment to a 2% inflation target.
Well, our next guest weighs in on the Fed's next steps, writing this. You don't have to remotely worry about the Fed hiking again, and the recession isn't here yet. Markets are likely to put their squeeze cap on and aim at the moon. Party like it's 1995. What does Alfonso Pacatiello mean about 1995? He's the founder, the CEO of Macro Compass. Of course, 1994, the Fed hiked rates from 3 to 6%. Job growth still continued. It was the very, I suppose, the very personification of soft landing. Are we going to have a magnificent soft landing 2024? Good morning.
Hey, morning, Manus and Danny. So look, 1995 was actually the only episode of soft landing ever recorded. In 1994, the Fed hiked rates, but in 1995, despite all the fears of hard landing, job growth was relatively stable and inflation went down to 2.5%, and the Fed could cut rates in the second half of 1995. That's exactly the setup that the market is pricing today. The market is looking at, if you look at the S&P 500 forecast for 2024, you have investment banks calling for anything between 4,800 and 5,000. Roughly, that's the median expectations for the S&P 500 next year. Now, if you look at what that means earnings per share 10 to 12% higher. That means the Fed cutting rates about 100 basis points next year, which basically is only possible if inflation continues to move down gradually and predictably towards 2%. Pretty much, we are pricing a picture-perfect market right now. And I think it's important to understand because you always invest against consensus. At consensus, it's basically parting like 1995.
Right. Well, Alfonso, on that, it's not just stocks. You know, Manus called me this morning and said, hey, Danny, can you make a chart of what bonds have done for the year? And I got really excited because I charted global bonds. There's Yeah. Well, thanks to you, Manus, because you forced me to do extra work, which, you know, apparently I'm always happy to do. But if you look at the blue line on there, that's global bonds, still negative for the year. But U.S. bonds, the U.S. bond ag, Alfonso, is now up 0.4%. We've erased the losses in this American.
Is that inflation is always and everywhere a monetary phenomenon. An economist a bit more famous than me once said that, right? And the issue is that money has been dried up pretty aggressively over the last 18 months, especially on private sector credit. If you look at mortgage applications, they're the lowest since 1995. If you look at the yields that small cap companies are paying to borrow, it's around 9 to 10%. So money is pretty tight, and with a lag, inflation has indeed slowed pretty aggressively. But now think about the opposite. If you keep loosening financial conditions, exactly like we are doing today, if this bond market rally extends further and further without the Fed trying to stop it too prematurely, what happens is that you're loosening financial conditions, you restart again the credit engine machine, and what happens mid-next year, in the second half of next year, exactly what the Fed was fearing, this 1970 setup where inflation does not go smoothly to 2%, but maybe it picks up again to 3 or 4%. So I think it's too early.
How big a risk is there of that, Alfonso? I mean, you know, let's be honest. Fool me once, shame on me. Fool me twice, shame on you. The banks have been bitten numerous times. They've tightened FCON. They've reduced credit cards. We've spent all our money. Come on. I mean, all right, the bond market's done the heavy lifting, but do you really think FCON is going to get that lice again?
Well, the situation here, Manus, is that it's true that we are so far looking at a soft landing. It really looks like and it smells like one. The only problem here is that the Federal Reserve has to retain credibility. They can't loosen too aggressively. This is not 2019, when Powell showed up in January and said, sorry, guys, we tightened too much. The stock market was down 20% in the last quarter of 2018. We need to loosen financial conditions because inflation was already at 2% back then. Today, you are not there yet. So Powell can't proactively ease, and I think he won't proactively ease to preserve credibility, and that's really the fine line that can put everything at risk.
Alfonso, only a few minutes ago, we got the EU Commission's Eurozone growth forecast. They lowered it to 0.6% for 2023. It had been 1.2% for 2024. So that's significantly weaker than their first estimation. If you're comparing the EU, let's throw the UK there, and the US, who's likely to cut first?
Well, as I said last time I was on the show, I think the European bond market is much more attractive than the US bond market. Well, since then, the European bond market has rallied aggressively, but the story is that all central banks around the world have tightened pretty much to the same extent. If you exclude Japan and Switzerland, all other central banks have tightened aggressively. Now, the situation is that while the US private sector is much more insulated from this tightening, you can't really say the same about the European one, or the UK one, or the Swedish one, or the New Zealand private sector, for example. Maybe even Canada, I would put into that basket. So those bond markets and those economies are the ones that are more likely to break, where people keep obsessing about the United States. There's an entire world out there which has tightened aggressively, even though they are not equipped really to handle this kind of tightening. Europe is amongst those.
When you look around the bond markets this morning, there's been these significant moves in gilts, significant moves across all global bonds. Aussies playing that classic catch-up. Do you think that we were so long going into these numbers? I mean, the CFTC data had us the longest on bonds since 2009. If you had to make a choice now about where to hide, as it were, on the curve, would you still be more drawn to the short end of the curve rather than taking duration, given the risk that you've just outlined that you could have whipsaw in inflation, as Jamie Dimon, he's a little bit more famous than all of us actually, suggested overnight? Just a thought, Alfonso.
Just a little bit.
Yeah, little tiny.
Well, just a tiny bit, yes. So I would defer to him, but if I would have to share my humble opinion on the curve today, I think one of the most crowded trades in the street in bond markets is to be in yield curve steepeners. So basically the steepener, the main thesis here was that the curve was going to steepen because the front end yields were going to drop, and so inflation would be coming down and the labor market would weaken, so you could buy 2 or 5 year bonds, but the economy wouldn't collapse. So you were going to get a typical steepener that you got, for example, in 2019. Now, That is still, I think, the main thesis around in hedge funds and in the macro community, and the bear steepening instead that we got validated the trade for the wrong reasons. I think it's very, very, very crowded, Manus, where everybody has the steepeners on. Yeah. You can see it yesterday where inflation really disappoints, and yet you can't really get the curve to steepen anymore. So what that tells me is that there is a very crowded trade. Everybody wants to be long 2 years because they say, look, I can get this 5% yields locked in. If something goes wrong, I make a ton of money. So 2 years is the place to be. Generally, my experience when a trade is very crowded and when it looks very obvious, it's not necessarily going to pan out.
Yeah, gone from -16 at the end of October to -40, where we are right now in 2s, 10s. Alfonso, thank you so much for joining us. Alfonso Peccatiello of Macro Compass. Manus, let's get to some of the other top stories that are trending on the terminal this morning. Schonfeld has ended a partnership talk with Millennium. Ultimately, Schonfeld backed out after securing up to $3 billion in verbal commitments from new and existing investors, including pensions and Middle East sovereign wealth funds.
Germany's top court struck down a key element of the government's plans to address climate change and transform the economy. That deals Chancellor Olaf Scholz's coalition a major setback that could throw its budget policy into disarray.
And Israeli troops entered Gaza's Shifa hospital compound as part of a precise and targeted operation against Hamas. The move runs the risk of raising international ire if it ends up causing more civilian casualties.
Well, coming up in the show, the Democrats agree to pass a proposed spending bill. It's a rare form of bipartisanship. But the shutdown is not yet averted. We'll discuss. Danny.
And later in the hour, we're going to be speaking with China expert Bonnie Lin of the CSIS on today's high-stakes meeting between President Biden and President Xi. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. U.S. House lawmakers, Manus, overcame partisan animosity to pass a temporary government funding bill, and now it greatly lowers the risk of a shutdown. Let's get over to Kate Ackley of Bloomberg Government on this. So, Kate, it passed the House. Does that mean we've avoided a shutdown altogether? What now?
Well, it still has to go through the Senate.
and it's expected to pass in the Senate. But you know how the Senate is, there are all kinds of procedural hurdles, so we'll see. It could be soon, it could be a few days, but I think the idea is that a shutdown is more or less going to be averted.
I mean, it's hardly what you call good fiscal governance. It's really just kicking the can down the road, isn't it, from the end of this year? I think you said they get to go on holiday in Capitol Hill, but we come back to this mess in January and February, don't we?
Right. You're going to have now, you're going to have to do 2 shutdown clocks because there's going to be some of the federal government agencies, their funding will run out in January, and then another tranche of federal agencies funding will run out in February. So the idea is to kind of, put the pressure on lawmakers to move that first tranche and then the second in time. But this is a new kind of plan. This was something that Speaker Mike Johnson and House Republicans came up with, even though a whole bunch of House Republicans voted against the plan yesterday.
I mean, Manus, how are we going to do this on Bloomberg TV? Are we going to have 2 shutdown clocks? Is the graphic engine strong enough for that?
I don't think I've got the mental strength to actually get through another shutdown, showdown, hoedown kind of thing.
Yeah.
It's like, every time you turn around here, it's like it's managing by crisis on a string, isn't it?
Yeah, welcome to America, Manus, is all I can say. And Kate, on that note, I mean, who are the winners? Is this a win for Johnson, or does it complicate things that it was really Democrats that helped get it over the line?
Well, the answer is both, really, and they're all kind of taking this as a win. This is a win for Speaker Johnson. He's avoided a shutdown in his first, less than a month on the job. But we're sort of grading him on a curve, right? This is just the very, very minimum kind of doing the job, if you will. So he's managed to get, this bill through the House with actually big bipartisan support. And so it is a win for Speaker Johnson. How long-lived of a win is it? There's some signs that he has problems in his own conference. You had a number of Republicans, some of the chair people, like Jim Jordan, vote against the bill. So there are signs of problems to come into the future for the new speaker.
Okay, and of course this bill went through, the White House has asked for, $106 billion in aid for Ukraine and Israel. None of that is in this bill. So, I mean, that just shows you where we are, how prickly this is. Kate, we could spend longer on this, but we'll be back to you. Don't worry, there's 2 new countdown clocks. Danny's looking at one, and I look at the other. Kate actually there on Bloomberg Government burning the midnight oil. Danny has made a good point. U.S. Treasury bonds are in the green again for this year. But, of course, you got this carry-through from that lower CPI yesterday. It was a re-rating across the bonds. Let's have a look at them. Aussie bonds, you've got U.S. Treasuries down 20 basis points yesterday, Danny. And Alfonso warned us there Alfonso Peccadillo warned us that this may not be like 1995, where we see this risk parity trade up in everything.
And the other thing he pointed out, if we look at the global bond market, it's still down 0.3% on the year. Yes, they've rallied over the past 24 hours, maybe continuing that rally. But Alfonso was saying to us, Manus, that this is where he wants to buy because the global economy is more weak than the U.S., and there will be cuts in Europe, for example, before the U.S. Okay, much more to discuss here on Bloomberg. We'll have a little bit of your sports news coming up on Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Bloomberg Brief. I'm Menace Crenny in New York. Danny Berger is in London. He's Irish. He's well known, not me, as Rory McIlroy. I mean, this is a cracking
Both
story.
great at golf.
Well, I wouldn't be so bad as like Alfonso to say perhaps he's a little bit more famous than me. He is from the same part of the world, from Northern Ireland. Rory McIlroy resigns from the PGA board. I mean, this man has got form. I will give him this. He's got principles. He stepped down from the PGA Tour. He has been vociferous in his condemnation and his dislike of live golf, hasn't he, Danny?
Yeah, I mean, you do got to feel for the man. He was one of the few people who were really outspoken about his dislike for Liv when it started. And then after the merger, he made no secrets about it, that he was blindsided and stung from the deal. I looked up what he said the day after the deal happened, the PGA PIF one, which of course is still trying to work itself out. He said he felt like a sacrificial lamb, that he stood up there and said his feelings, and this is what happens.
I just looked at the New York Times article, and he said, "I hate Liv. I hope it goes away." And of course, you know, we're still in trying to get that deal closed. I mean, this is an explosive thing. I hate Liv. McIlroy, one of the new circuit's most fearsome critics, said on Wednesday, I hope it goes away, and I would fully expect that it does. Of course, that is not the situation for him. So that's contentious. But of course, Manchester United never far from a story as well. We've got Leon Cooperman punting a stake. Well, I don't know, taking a stake, a million shares, so 17 million bucks. Leon's putting into Manchester United this morning. There you go. There's Manchester United at £18.83.
Yep. Maybe making a bet that a deal is soon to come. Will it be Ineos? Will it be Jim Radcliffe? We'll keep you up to date on that deal when it happens. But coming up first, Manus, we're going to speak about President Biden's meeting with Bonnie Lee.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Stock surge, yields plunge as U.S. CPI data stirs hopes that Fed hikes are over. But Ken Griffin and Jamie Dimon are waving warning flags. China's Xi arrives in the U.S. ahead of high-stakes talks with President Biden. Military communications, export controls, and fentanyl top the agenda. And Burry's bets, the money manager is once again long on Chinese e-commerce giants Alibaba and JD.com after giving up on them just months ago. Well, if you had given up on this equity market, today would have been a bad day for you. It was a bad day for the shorts, the biggest short rally since November 2022. You can see that just by looking at the Goldman Sachs most shorted index. 7% is how much higher we moved. Small cap stocks also surged with that, over 5% for the Russell 2000. And we're higher yet again this morning, 0.3 for the S&P, nearly 0.5% for the Russell 2000. However, Dan Suzuki over at Richard Bernstein, the CIO, says that this market is not moving in line with fundamentals, and he would fade the extremes unless something changes. China, good news there. Also more stimulus coming from the Chinese policymakers. So not only does China and the MSCI Asia Pacific Index Manus play the catch-up game, it also gets an extra boost for that. So up on the day about 2 1/3%.
Yeah, a lovely Santa Claus rally perhaps coming a little bit early. When you look at the bond market, you just got to ask yourself whether higher for longer really just got slayed yesterday on the back of the CPI in the USA. And of course, in the UK, inflation at the lowest since 2021. But look at this, quite a dramatic 20 basis point move yesterday. It's a very, very crowded trade, according to Alfonso Pecatello, who we've just spoken to, which is the curve steepeners. That is your risk. The market is also pricing in 50 basis points of cuts by July of next year. So the market is perhaps getting a little bit ahead of its skis. Roll it over, have a look at the cross assets, and you have, again, where do you want to hide? Do you want to be in the short end of the curve? Ken Griffin at Citadel, we'll hear more from Shanali and Ken Griffin in just a moment. The credibility of the Fed is at stake if they cut too soon. So you're seeing a small pull up higher in these yields this morning, 484 sterling. I mean, the dollar took a massive smack yesterday, so there's a little bit of reprieve. Sterling is down by 0.25% as we see that inflation come in at 4.6%. That is the biggest drop in inflation in the United Kingdom since 1992, and the market is now pricing in 78 basis points of cuts in the UK by the end of next year. Iron ore has put a little bit of green on the screen. We're above $130 on iron ore for the first time since March. And again, this goes back to the stimulus narrative downing from the Chinese, $137 billion going into the Chinese housing market. So again, as Xi lands in the United States of America, he's dealing with some stimulus aspects at home in China.
And then amid all this everything rally, Manus, I really like what Alfonso said that we've been hearing more of. This idea that you'll be restarting the credit engine with looser financial conditions because bonds and stocks have rallied. So he said what happens mid next year? It's the 1970 setup where it doesn't go smoothly back down to 2%.
And I think his biggest fear was, you know, the perfect soft landing was 1995, which is where employment still continued to grow. The Fed had hiked rates in 1994, and we had this risk parity event of everything surging. So the question you need to ask yourself now is, what is my risk of a massive risk parity updraft and 1995 redux in 2024?
Well, maybe we can also rally off the back of less benign geopolitics. You'd mentioned this, Manus. We have Biden and Xi meeting today. It's been much anticipated. The expectations is that it can maybe thaw some of the tense relations. Citadel founder Ken Griffin also spoke exclusively with Bloomberg's Sonali Basak in Miami on his hopes for the outcome.
It's really important that we try to find common ground to build a better relationship with China on, rather than continuing this downward spiral of tit for tat on trade policies and otherwise. Our economies are incredibly coupled together, and an abrupt decoupling would come at just catastrophic costs to the people of both countries.
Joining us now to discuss this is Bonnie Lin of the Center for Strategic International Studies. Bonnie previously served in the Office of the U.S. Secretary of Defense as a senior advisor for China. So, Bonnie, we're really appreciative for you to make the time to join us so early this morning. For you, looking at a meeting between Biden and Xi, what would be success?
Well, thank you for allowing me to join you this morning. It's a pleasure. In terms of looking at the meeting and what would be successful, I think the administration, as well as the Chinese side, have been trying to set low expectations for those tuning in and watching the meeting. Part of it is the recognition that U.S.-China relations, prior to this meeting, we had been improving slightly, but there is still a lot of hard issues between the two sides, including Taiwan, that this meeting is not going to solve. A couple of deliverables that folks have mentioned might come, or potential outcomes that might come. Top of the list include improving military-to-military ties. There's also discussion that we might be able to get some agreement from the Chinese on China working to curb the export of precursors for fentanyl. And of course, there's also been discussion on potential U.S.-China agreement on being able to regulate how artificial intelligence might be used in controlling autonomous weapons, as well as potentially the use of artificial intelligence in the control of nuclear weapons. But I think we should have reasonable expectations that this one meeting is not going to significantly improve U.S.-China relations or reset the relationship.
Bonnie, look, both sides need one another, and they're at pains to sort of emphasize that from the U.S. that they don't really want to fully decouple. But when I look at, you know, Xi has had a collapse in foreign direct investment into China. Economically, he's under pressure. I just wonder what would be a win in the domestic news narrative and the economic narrative for Xi at this, because of course there is progress towards ending the freeze on Boeing. You know, we've got a lot of tech angst. So what would be a win for Xi to arrive back in China and say, this is what I achieved with meeting with the President of the United States of America for the economy?
Oh, that's a really good question. I think we might not know until after APEC. We do know that one of his agendas, exactly like you said, is to cater to investment from the United States. So aside from the meetings that he has with President Biden, as well as meetings that his delegation will have with some of the other U.S. folks on the U.S. side, he does plan to attend a CEO summit. And I do expect during that summit that he probably will be looking to make the case of why it's still in the interest of U.S. businesses to invest in China. So hopefully we'll see, he might see some wins from there. The other thing is, I think it's an optics issue for President Xi Jinping. When he arrived in California yesterday, he was greeted by Governor Newsom. It's a very wonderful optic for him as an international leader to be welcomed to the United States, to showcase that he can manage U.S.-China relations. And that helps address some of the domestic criticism that we've been hearing that he has been at least facing at the mid to low levels within his government.
Is there not also an optics issue domestically in the U.S. for Biden? Because we've long talked about this idea that China opposition is the only thing that unites both the right and the left in America. Does Biden also need, or is he expected to tread more carefully because of that China critique?
He's definitely treading carefully, and that's, I think, why the Biden administration is trying to set low expectations from this meeting. The engagement that the United States has engaged with the Chinese side has already led to, as you're well aware, significant criticism from a number of leading Republican candidates. And I think what President Biden needs is something positive that he can point to. And I think what he is looking for, or what would be very positive, at least on the domestic side, would be if we can achieve any clear agreements on fentanyl. As you know, an issue that has major domestic implications for the United States.
Yeah, I mean, that would be a significant social flag to carry through in the United States of America in 2024. You mentioned Taiwan in sort of the very first breath. You mentioned Taiwan, and yet here we are. We have a Taiwanese election at the beginning of next year, and we have a U.S. presidential election next year. The world is talking about Ukraine, Russia-Ukraine, and Hamas-Israel. But there is an unspoken level of tension in the Taiwan Strait. You know, what could be said around that could alleviate that as a key pressure point in 2024? Because Biden does not need that going into his election run at the end of next year, does he?
I completely agree. And I would say probably no U.S. leader needs another potential third crisis or conflict. So I think the Biden administration is being very careful here, mainly because they're aware that anything that President Biden may say to Xi Jinping during this meeting, there is a potential that the Chinese side may have incentives to share that publicly. We've seen some of that in prior high-level meetings. But President Biden does seek to use this meeting to make sure to reiterate many of the assurances that he has already provided China with respect to Taiwan. That includes, for example, making clear that it is not the policy of the U.S. government to support Taiwan independence, as well as making clear that the United States is not seeking to use Taiwan as a card to contain China or as a card against China. A lot of these assurances President Biden has already provided to Xi Jinping at the Bali meeting, the last in-person meeting between the two leaders last year.
And if there are talks about arms controls between the two leaders, can China bring Russia along on that too? Is that something that China has the ability to bring to the table?
That is an excellent question. I think it would be quite difficult given the state of U.S.-Russia relations, but we will need to see. And I think it would be an excellent first step if we can reach any arms control agreement or even have good substantive arms control dialogue with China to begin with. And then from there, we can see what we could do with Russia, too.
Okay, Bonnie, let's see what the day brings corporately, politically, on all of those touch points. That is Bonnie Lin of CSIS on the Xi Biden meeting. Coming up, we're going to hear from the man himself. We talked about him quite a bit, Ken Griffin, on why he believes working from home could mean more job cuts. Get yourself back to the office quick. Shanali Basak is on tour. She needs to come back quickly. We'll talk about Ken and Shanali in a moment.
Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
On the next episode of the Business Week Show.
Reputation. People say, oh, well, LeBron gave you an opportunity, lucky you did this. But you don't talk about Donald Trump's dad gave him a loan, James Dolan's dad gave him a business. What's the difference?
I try not to care too much about what people think, and if that helps others see that there's more to life than a good reputation, that can be a positive step.
Watch the Business Week Show Thursday nights, 10:30 Eastern on Bloomberg Television or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger alongside me in London. So the labor market recovers from the pandemic. Companies are trying hard to get their employees back into the office. The Citadel CEO Ken Griffin discusses the downsides of working from home.
It's been really hard to hire people. And as such, your large companies have been very reticent to let people go no matter what the circumstances are. So even if margins are contracting, even if you have gains from automation, people have been very reticent to let people go. Now we're starting to see for the first time the unwinding of that labor hoarding. What we don't know is how much of that labor hoarding has taken place. And then what worries me in a hybrid work environment or work from home environment, the cultural or social contract that holds people together in a company is unquestionably weaker. I mean, we've all read about companies that have fired thousands of people on Zoom calls. There's no sense of, that's Jane who's worked down the hall with me for years, and I'm going to go the extra distance to try to keep Jane employed here. It's like, here's the email to all, here's the video conference with a bunch of people, and goodbye. It's a very different moment in American employment history where I believe the bond between the company and the employee has become far weaker. And that worries me in terms of the willingness of corporate America to make cuts on their workforce that they just wouldn't have made at other similar points in the labor market cycle.
Is that you saying that the employment market will crack much more significantly than many are expecting?
It could, is what I'm saying. It could. It's a wild card.
Words of warning there from the Citadel CEO Ken Griffin, speaking on a wide-ranging conversation with our very own Shonali Basak, who's in Miami. Shonali, thank you very much for getting up early. Great work yesterday, great conversations, and you made lots of headlines. What's not to love? Now get back here to the office, because that's the risk, isn't it? We love, you know, it's all about being together at 2:30 in the morning. Just saying.
It certainly is. I know I need to get back as soon as possible because, you know, who knows what happens if I don't. But the interesting thing, too, you know, he had a lot to say about the economy, and I think you saw a lot of this reflected in the 13F views also in terms of that fear about the future of the direction of the economy, didn't you? And his view about the labor market, he didn't want to call here a hard landing or anything of the sort, but you definitely did hear the caution, didn't you?
And it does feel, you mentioned the 13F filings that came through last night. Yes, it's backwards looking, but it seems like maybe that overriding fear is just manifesting itself in buy a lot of tech.
Well, that's interesting too. Buy a lot of tech, but if you take a look at the whole holdings in aggregate over the entire investment community. In the first 5 holdings, you did see, for example, Amazon in that list of holdings, Danny. But in aggregate, you actually saw the entire investment universe as net sellers of the technology industry. And in that first 5 set holdings, you saw Apple, you saw AMD, you saw and a lot of big tech companies, Alphabet, as big sells in terms of position changes. And I wouldn't say this reflects a want to get out of the stocks, for example, but you definitely saw a lot of investors taking profits. Take Rokos, for example, and their approach to QQQ. You saw them pull back a little bit. And that big Michael Burry story also about them really reducing their exposure to the likes of NVIDIA. That was up 230% or so on the year. And so this profit taking and this worry at the same time about betting against the market, I think really shows you where people are right now.
Well, of course, you mentioned Michael Burry, and we've got the 13F filings as well. He's taken another bite out of Alibaba and JD.com. Just for anybody that's tuning in, JD.com had their numbers this morning. Net revenue 247.7. That is a beat. And of course, it was Singles Day. Is also something that they touted around as being a driver for them. What is it? Fool me once, shame on me. Fool me twice, shame on you. I mean, this man's a smart man, Michael Burry. He's back in. He's in like Flynn again. And this is a hard pivot, Shanali. I got there. A hard pivot by Barry. It's called thinking on your feet.
It is a hard pivot.
Yeah.
And he's not the only one. You think about the people that had gotten out of stocks related to China because of the worries about the geopolitical tensions or valuation. Wimps, total wimps. But look at, as you say, they're right back in, aren't they? And, I've got to say, even here at the Citadel conference that I've been at, there has been a lot of discussion about the role of China. And, Griffin himself even talked about the inability to decouple from the Chinese economy, despite any worries about the Chinese economy or the tensions between the U.S. and China. Griffin even went so far as to talk about his advice to President Biden and trying to maintain both a stern tone when he is negotiating, but also a recognition of the U.S. reliance on the Chinese economy and vice versa.
Can I tell you guys something really depressing? Me, a human who lives in the UK, was for some reason served an ad for Singles Day, and it was a roast dinner for one, a discount on a roast dinner for one. I can't think of anything more depressing. Can I just say they haven't obviously been to the 3 formal settings that Danny has hosted over the past year. What are you doing? Another what? A wedding? Another one. I've had a few wedding kind of celebrations. I don't think that's for TV to discuss. Anyway, Shanali, thank you very much. I'm in trouble. That is Bloomberg's Shanali's Basak. Manis is going to get a talking to after this program. Anyway, Manis, shall we talk about Alstom?
Oh yes, let's talk about that. I could do that. I could do that without getting into a lot of trouble.
Let's talk about trains. Okay, so this is a company, a European company. It makes kind of all the trains in the UK, in the US. It makes subway trains. It makes DC Metro trains. Man, it's down by 20% today.
That's what you call a slap. I think that's like almost €1 billion of equity wiped out. Why? Because they're slashing €2 billion off their debt. They're cutting jobs. The market is now apoplectic about their balance sheet. 1,500 jobs to go. They're selling assets to raise cash. It's a bit like that gift that I'm going to buy you. I don't know what I'm going to sell.
Oh.
Yeah. Because now
it's going to be a $51 million
I actually feel really
Ferrari, right?
bad now. I'm in the naughty corner, aren't I? Yeah.
Manis, you could never be in the naughty corner. Don't worry, Manis.
Okay,
you know what will make me feel better? If you give us a check on markets, that will make me feel better.
I'll do that for you. Let's have a look because it's live long and prosper like 1995. You're going to have the potential as these yields drop. I mean, we're studying a little bit on the 10-year government bond yields this morning. 446. We did a 20 bip drop yesterday on that. SPOs are up 1/3 of 1%. NYMEX crude down by 0.4%. Good morning from New York and London.
worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
You're watching Bloomberg Brief with Danny Berger in London, Manish Cranny in New York. Let's get you set up for your trading day and take a look at what's ahead. First, we're going to get a lot of retail earnings. We have Target and TJX both reporting before the U.S. market open. And then it's a lot of data. U.S. PPI retail sales, both of them will come at 8:30 a.m. Eastern time. Current estimates showed that retail sales growth likely slowed in October, feeding into that disinflation narrative. And President Biden and President Xi holds a bilateral meeting at 2 p.m. Eastern outside of San Francisco on the sidelines of the APEC summit. President Biden holds a news conference afterwards. And then we're also going to be having the UK Prime Minister Manis holding a press conference at 4:45 London time. This follows after a ruling from UK courts. It broke only 10 or so minutes ago that his policy of sending asylum seekers to Rwanda is unlawful. So Rishi Sunak calling that decision disappointing. So he will be holding a presser in a few hours' time.
And of course, the debate there is, what is plan B? Rwanda was the destination where they would take many of the people that did that horrendous journey across the channel from France, take them, put them into Rwanda. The Supreme Court has said that the plan is unlawful. There is a real risk of harm to people if they are sent to Rwanda. So, of course, Sunak is under this policy of stop the boats. So let's see what he's got to say a little bit later. Now, I haven't been to Target yet. You were extolling the virtues of Target before we went to the break. But we're going to get the numbers. And, of course, last quarter, their sales dropped by 8.5%, Danny. The question is whether the inventory drawdowns bolster the margin. Target is up 2.8%. NVIDIA barnstorming away ahead again.
Yeah, extending gains. It had jumped to a record high. Here we go, about to hit another one. It's now matched the longest winning streak ever, Manis. So everything rally continues well on its way.
And not to be left out of course, Michael Burry covered his short on some of the semiconductors. That's it for Bloomberg Brief. We give you the surveillance team in Unity on Bloomberg.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. Where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago, because Treasury bills are 5%. So I would say, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask, really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire? And that will determine your investment decision.
So what do you think is the most common mistake investors make when they have 100,000, $1 million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
View is that the Fed probably is done.
For the Fed, yes, the bar is high for another hike.
We will get a period of slower growth, but that's not surprising.
There's disinflation in the U.S. economy, and we're heading back to 2%. The question is, how long does it take to get back to that 2% inflation threshold? And I think in that context, we have to have patience.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a 24 hours in this market. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P 500 positive once again. TK yesterday, that was the sound of a declaration of victory over inflation in financial markets.
It wasn't transitory. It happened right away there at 8:30 with the shock CPI report and the nuances of it. And John, I can honestly say, as Lisa and I tackled it, you were off on your break with your interns, but Lisa and I at 8:35, at 8:45, at 8:50, it just kept coming on. Here's the statement. I've never seen it before.
I was logged onto the Bloomberg for the close, TK. Best day of gains on the S&P 500 since April. Small caps up more than 5%. Best day this year. S&P 500 real estate, best day this year. Nvidia up for 10 consecutive sessions. Bramo, the moves we saw yesterday, I think we've got to remember this, off the back of the smallest of downside surprises on inflation.
That is an important clarification. A 0.1 percentage point difference in the inflation rate that people were expecting versus the one that they got. You could make all sorts of other excuses, like the whisper number was higher. Nonetheless, to declare we've done it, we've got victory, we actually have won against the fight of inflation on the heels of a downside surprise like that, tells you what people want and how much the narrative is shifting, regardless of whether it sticks.
Yeah, I don't think the Fed's going to jump on board just yet, TK. I heard that a lot yesterday. It is too premature for this Federal Reserve to do the same thing.
Really strong. I'm going to major shout at Jason Furman, teaching all of us besides Ec10 at Harvard. He did great analysis, along with others, of 3-month annualized, 6-month annualized, some really complex formulas that are, okay, what is the total picture? And instead of saying mission accomplished, and I teased people with that, knowing it's not, the question is the vectors in place. This really accentuates the disinflationary trend.
There's so much happy talk, it's overwhelming. Neil Dutter of Renaissance Macro capturing this perfectly in this quote yesterday. The inflation data, Bramo, soft landing nirvana for equity markets.
It was nirvana if you take a look at all of the internals too, because not only did you get serious disinflation, outright deflation, even in things like airplane tickets, which people weren't expecting, but you also had real wages increasing. So basically the consumer picture was actually doing better at a time when you did see disinflation continuing to accelerate. Tom?
Was Nirvana a band?
Nirvana was a band, yeah.
Oh,
It was
okay.
also a band. Good band too, Tom.
Okay, I got that.
Early mid-90s.
Yeah.
Yeah, your kind of music.
What about more? We got more of an add-on here, and it's into the end of the year. Ben Laidler out with a note saying, guess what? 1/5 of returns, historically, 1/5 of returns come in December.
David Costin, Goldman Sachs, out with the
What did he
outlook. Do you want the number? 4,700 year-end next year. Not far away from where we are right now. Here's the line that I think matters because they're really constructive on the economy in 2024. The current starting point will limit the potential appreciation for the benchmark US equity index in 2024. Our economists forecast above consensus GDP growth for next year. But Lisa, this view is already reflected in equity prices. So take all the happy talk of the last 3 minutes. Have we already discounted it, Bremo, in markets?
And so, in other words, you could get sort of a tepid year of gains. Increasingly, though, our conversations are a lot more nuanced about where the gains are going to come from. And that's why I thought that the small cap move yesterday was so interesting. It was the biggest gain in almost a year. And it really comes in the heels of everyone saying we like it, but we can't really bank on it because we've been burned again and again and again. So at what point does this actually lead to some normalization in terms of correlations in a way that sort of belies the meager gains that implies?
This move yesterday was the definition of an everything rally. The equity market move continues this morning on the S&P up by 1/3 of 1%, equity futures pushing higher. Bond markets yesterday, double-digit moves on yields lower across the whole curve. 2s out to 30s. This morning, we're up a couple of basis points, but Lisa, still south of 450. Your yield this morning, 447.
Ira Jersey yesterday of Bloomberg Intelligence was talking about the lack of liquidity and the violent moves. And again, do we get a sense of stability, or is this just a rally with a new narrative shift that's going to, portend another narrative shift down the line? 8:30 a.m. U.S. retail sales and PPI data comes out. Will PPI confirm what we saw yesterday with that CPI print? Retail sales, really important. We kept hearing that from guest after guest yesterday. Do we see a deceleration after last month's surprise 0.7% gain month over month, year over year? We have sort of normalized, even with inflation baked in.
What's good for the market today in retail sales? Is like good retail sales good, or is bad retail sales good?
Are you the one asking if good news is good news this morning?
Well, after yesterday, I'm like, okay,
is that what you're
what
asking?
do I want in retail sales at 8:30?
I think based on current disinflationary trends, any signs of decent output, Bramo, is good news, because a lot of people at the moment seem to be shaking off the threat of that transpiring turning into higher inflation anytime soon.
I just am thinking about Stuart Kaiser screaming at his television right now, saying
would
good
say
news
good
is
news
good
is good
news,
news,
period,
yeah.
full stop,
Yeah.
and this is what we want. Today we also get the color commentary from some of the big retailers. 6:30 a.m., about a half an hour. Target comes out with earnings. 7:30 a.m., TJ Maxx. What I'm curious about is how much do we see, Target reaping the benefits of some of their cost cutting. TJ Maxx would be interesting. Discounters, are they getting attention as consumers cut back around the margins? And today, the APEC summit is taking place, headlined by Xi Jinping and Joe Biden. They're meeting this afternoon. You can expect photos and handshakes and press conferences, I believe. But this actually might be more interesting. At 10:30 p.m. Eastern, Xi Jinping is going to headline this dinner with the CEOs. He's increasingly looking for business diplomacy. How much can he really offer some of these executives to give them confidence?
Is In-N-Out Catering?
AMH with big
dinner?
reporting. AMH with big reporting in the last 12 hours. Secretary Yellen in and
Did you
out.
see all those executives with their little
We've
bag?
got the order, TK. Cheeseburger with onions, fries, and a Diet Coke.
That's like all she's missing
On
is
the
a
way to the
tang.
airport.
I'm so judgy of Diet Coke drinkers. I don't know why. I don't know why.
It's a British thing, Lisa.
I don't get it.
So now you have a totally different view of Janet Yellen?
Diet soda.
Most people thought that it was a pretty baller move of her to do that.
There's nothing baller about Diet Coke.
No, not that. Of going to In-N-Out on the way to the airport to pick up Xi Jinping. It's just very kind of,
Could you see
college
Steve
student.
Mnuchin in In-N-Out?
In-N-Out?
Pick it up.
No, I can't.
He goes, can I buy this place?
Should buy this place. Great burgers there.
Oh, thank you.
Fantastic. Ben Gutteridge joins us now, Investment Director at Invesco Investment Solutions, wondering where this conversation is going. Ben, we're going to talk about markets, don't worry. Soft landing nirvana for the equity market. That's what Neil Dutta of Renmax said yesterday. Is this soft landing nirvana for the equity market?
Well, I mean, it's certainly, Goldilocks overtures, whatever fairy tale spin you want to put on it. But yeah, these the combination of forces, quite rightly, lifting equity markets and sentiment, of fading inflationary pressure, resilient growth, rate hikes in the rear view mirror after a troubling, post-summer period. I think, clearly markets can give a little bit back after such euphoric gains, though not today. No, I think there's nothing irrational, I don't think, about how the market's performing of late.
Ben, you've been a real student of these markets. To me, it screams second leg of a bull market. Like there's a malaise of 76 into 77, and then boom, second leg of a bull market. Does this feel second leg off the October lows 13 months ago?
Well, I wouldn't. Perhaps I'm evoking too much enthusiasm here. I certainly think there's gains to go for at this stage. As I said, that resilient growth story can run. I don't think a recessionary threat is immediate as we look to the first half of next year. And as I said, with rate hikes in seemingly behind us, that can support momentum, along with like a reasonable amount of cash on the sidelines looking for a home. But I wouldn't want to lose sight of the severity and pace of interest rate hikes that we've seen. I think recessionary risks are material for sort of second half of next year. So, want to enjoy the spoils of market momentum, but have to be thoughtful about when to pivot to get a little bit more defensive. So couldn't quite get on board the idea that this is sort of the start of a sort of second bull market, as you put it.
Yeah, I look, Ben, at the second bull market in the sectors here and just observing it. Do you see breadth in this move? I mean, a shock move off one inflation report. Is there going to be a new breadth out of this globally?
Yeah, I would suggest, probably more breadth outside of US large caps, though we do believe they should continue to enjoy positive momentum. But just as we saw in US small caps and actually sort of slightly better data internationally, be it some European survey data about where growth is going, it wouldn't be quite such a concentrated area of gain. So, international exposure, slightly more value, slightly more small cap exposure, looks like a reasonable trade into year end. But you've got to be nimble to take those. I mean, actually, in our sort of portfolios, reluctant to be quite so tactical, and do find some comfort in US large caps to be able to enjoy gains at this moment, but also be there to cushion some of the blow from losses that might materialize in the face of a recession next year. But the shorter term trade, I think, is breadth, small caps, value, and international away from US.
So, Ben, I'm still stuck on the poetry that you uttered. Enjoy the spoils of market momentum, and you talk about being nimble. And it sounds wonderful, like going to a party and eating until it's done. How do you know when it's done, and what does it mean to remain nimble and enjoy spoils of something you know is soon to end?
I'm clearly just so bought into and caught up in the euphoria of market moves. I must be giddy in my communication. But look, I think, because of market momentum, because growth is looking resilient, and maybe there is something of a manufacturing recovery, like the destocking cycle that we've seen, running down inventories, that looks like it might have run its course. And with, as I reiterate, with rate hikes in the rearview mirror, there's a lot of reasons to be positive. And so with cash on the sidelines, I think the breadth is a natural outcome of increased optimism. And I think this can run into the end of the year. But as I sort of said, if you can make trades for sort of months, 2 months at a time, it's worth going for. But if you're slightly more cautious in your execution and are alert to the risks of recession as they build, I think, through next year, then maybe more resilient assets such as US large caps you might be better off just sort of sitting there and enjoying perhaps less relative gains in the short term, but less volatility as well.
Hey, Ben, thank you. Ben Gunridge there of Invesco Investment Solutions on his latest views in this market after a stellar move yesterday. What do we all think of lyrics in Southside Research? What do you think about that, TK? This from David Costin. Follow Taylor Swift's advice in the song from her 1989 album, All You Had to Do Was Stay Invested. Does that work for you? I'm not big on this stuff.
This is
I'm not big on this stuff.
Well, Constance brilliant, but
Buscemi's,
I feel like that was almost like a bet that he had to get it in there because ultimately they're only looking for that much upside anyway. So does it work?
We're talking about it. So isn't that working?
Sure.
And how do you make something more entertaining?
Well said, Bramo. Well said. I am talking about the note from Costin. There's a whole bunch of reasons why they do think there's limited upside here, and it's worth going through them, Tom. The above consensus GDP growth story that they're looking for in 2024, Costin says, is already reflected in equity prices. Margins have stabilized, but substantial expansion from current elevated levels appears unlikely. He thinks that we're fairly valued at the moment. Even if the Fed has finished its hiking cycle, they will remain on hold until Q4 2024. TK, that is the Goldman view.
What are we going to see here into the weekend? We're going to see it here, John. SPX up 0.3%. And guess what I'd like to see? I'd like to see a lot of people, including me. Humility is in order. And Dennis Gartman, for 30 years, has led the way with candor when he's wrong. I talked to him the other day, John, and Dennis Gartman just said, Tom, I flat out got this wrong. We need a lot more of that.
Lots of people got this year wrong. So I wonder how they're thinking about next year and what they think the biggest risk is. Is it that we get a material weakening of this economy, or does this expansion just persist in a way that's unexpected and doesn't lead to rate cuts in 24? Much more on that in just a moment. Equity futures right now still positive on the S&P 500 after a monster day of gains in yesterday's session. From New York City this morning, good morning.
In global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to suicide.
Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. A new industry is poised to launch. Electric air taxis are on the horizon.
You will see these products come to market by the year 2025.
CFO Mark Messler has Archer Aviation on a financial path to a smooth takeoff.
I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
Watch Chief Future Officer today on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
When it comes to government funding, as I have long said, it has to be bipartisan. And right now, that's the path we seem to be on.
We are not going to have a massive omnibus spending bill right before Christmas. That is a gift to the American people because that is no way to legislate. We've gotten together. I believe there's going to be bipartisan agreement on that to break it up.
That was Senate Majority Leader Chuck Schumer, House Speaker Mike Johnson speaking just hours before a bipartisan vote in the House passing a stopgap funding bill that would avoid a potential government shutdown. That bill now moves to the Senate. So, TK, here's the good news. We might deal with this week. Here's the bad news. We're going to deal with it a few times going into New Year, TK. This story's not going away.
Yeah,
the story's not going away.
It's not going away, and it's sort of pretty tragic. And what gets me going, you know, I'm somewhat of a student of this. As you look at some of the charts out on Twitter, and again, I can say I've never seen these charts, like the amount of interest we're paying 1 year, 2 year.
The market loves a can kick.
Global interest payment.
That's great news. We don't have to deal with it going into Christmas, and maybe we can open the door to a bigger center rally into year end. Your equity market's just flying over the last 24 hours, up a third of 1% this morning on the S&P 500. Yields aggressively lower across the curve yesterday. 2-year out to 30-year bonds. The 10-year maturity, you were tired, Tom, by a couple of basis points. It doesn't matter what I say right now, does it? You're just going to talk over me and say something different.
I mean,
can I just finish on the yield and the 10-year? Is that all right?
Please.
Just see if you can allow me to speak without saying yeah 5 times.
Yeah.
447.26 on a 10-year. Go.
Go. Market drawdown.
Here we go. I knew it had nothing to do with bonds. I knew
2021. John, look how the NASDAQ is made up. Look how the NASDAQ has caught up so quickly in the last month. SPX, -6. Drawdown. Dow, only -5. NASDAQ, I was stunned. I thought it'd be like -11. -4%. That's how fast we've come back.
It's amazing.
It's amazing. I had no idea. Continue.
No, I'm done.
Okay.
I'm so done.
Right now, we are never done with Maya McGinnis, president of the Committee for a Responsible Federal Budget, for 2 reasons. The federal budget's not going away, our debt and our deficit. And just importantly, Maya was an 8th dan or a 9th dan in judo, and she's now up to 10th dan, so she can self-defend herself in our fractious Washington. Maya, in all your years in Washington, have you ever seen it so violently polarized?
Oh, absolutely not. I mean, what's going on right now, I think about this a lot because this is a moment where we are so distracted with our infighting in Washington. We are absolutely missing the big picture of what's going on externally. And there are external threats from rivals around the world that should be unifying us and helping us function. And I fear it leaves us in an immensely vulnerable place. So we have these huge parallel risks here, which is our fiscal situation leaves us really vulnerable, and our political situation leaves us really vulnerable. And the noteworthy thing is now it's within the parties, not just between the parties.
Explain to all of our listeners and viewers the one item that's front and center, which is our rising interest expense. Translate how we should interpret, as a round number, a $1 trillion government interest expense.
It is a bright, flashing warning sign that the U.S. fiscal situation is unsustainable. So $1 trillion in interest is sort of shocking, but absolutely sort of predictable because we're borrowing so much every year and it's getting worse even when the economy is so strong. Interest is the fastest growing part of the federal budget, eclipsing healthcare that was for quite some time. We spend more on interest payments than we do on all spending for children under 18 at the federal level. And within just a few years, we're going to be spending more on interest than we are in national defense. Clearly, it's squeezing out all these important priorities. Whatever your particular ideology is, there's not going to be as much money for it because interest comes first. And just let's keep in mind that when interest rates were low, there were all sorts of people saying, borrow more, borrow more. It's almost like it's free. It's not. It wasn't. And this is the moment where it shows you that if and when interest rates go up, and they almost always do, the huge debt load that you have as a result of people encouraging to borrow more leaves you immensely vulnerable and squeezes out other priorities, both investments, national security, and anything else that we might want to be spending or preparing for.
Yesterday, money got a little bit more free, or at least a little less expensive. How much of a bond rally are we away from being sustainable on a fiscal picture?
It's not coming from a bond rally. It's coming from changes to the structural budget situation. So the markets can do whatever they are. I mean, when interest payments weren't the fastest area in the budget, that was a big relief. It took some pressure off. But listen, you still have huge growth in spending from the aging of the population and ongoing healthcare costs. So Social Security and Medicare are going to continue to grow much faster than the overall economy. Revenues are not going to keep up with it unless our policymakers do something. And I know that that feels kind of difficult to imagine right now, but unless they do something hard, which is look at the real budget, the entitlements and the tax side, and make some changes, this unsustainable separation between the two and growing deficit and debt is going to continue.
You talk about how, based on how things are going, it doesn't seem like they're actually going to do anything. We're more focused on Elbowgate with Kevin McCarthy yesterday in the House than we are on tangible gains with respect to reducing the deficit. Do you feel like you're banging your head against the wall when you talk to the different Congress members and try to get them to hook into more sustainable solutions?
You know, I don't right now because there's been a very, very encouraging sign both in the House and the Senate in a bipartisan effort, which is to put together a fiscal commission. And what the commission would do is look at all these parts of the budget over the next year. It's no guarantee it works. It's still really hard choices, and Congress doesn't like to do anything difficult right now. What they like to do is cut taxes and grow spending and give away things. But the benefit of a commission is it gives members a chance to actually build a working relationship where it doesn't come to blows, build trust, understand the issue better, and give some political cover if they come up with recommendations to be adopted. One great thing would be if they could come up with a Social Security fix, given that that program is headed towards insolvency in about a decade.
Maya, how close are we to another Simpson-Bowles effort?
So, as I said, it's bipartisan, bicameral. That's a great start, but there's already lots of opposition for no reason but political. I don't know how you can look at a program that's headed towards insolvency and say, hey, stop, don't try to fix it. But that's what a lot of people are saying. You're hearing from the White House criticisms about the notion of a fiscal commission. All sorts of people, I think, want to politicize these issues. But overall, I think there is broad-based support, and I think it's growing. And basically what I see is at the end of the year, we are going to have a lot of borrowing for emergencies and legitimate emergencies, perhaps also some tax cuts that should be offset. They're talking about a deal where you would extend some business tax cuts in return for the child tax credit. That's a borrowing deal and a borrowing deal. But if they do end up borrowing a lot more, I think this clamor for doing something and the fiscal commission as the best mechanism to do it is only going to grow. So I could see that being part of a deal at some point soon. They're going to have to do something. The warnings from, rating agencies and the Congressional Budget Office, they're just going to keep coming.
Big time. Maya, thank you for your perspective this morning. Maya McGuinness there of the Committee for a Responsible Federal Budget. There is a big battle over spending on the horizon. Maya mentioned the credit rating agencies. Let's go to Moody's and what they had to say going into the weekend. Federal interest payments relative to revenue. This is what they expect in 2033, 10 years from now. That's going to climb to 26% from 9.7 in 2022. Tom, that is a huge, huge number.
And that's why it's so important to listen to people like Maya McGuinness, because I think on this topic, it's not that there's bad information or false information. There's just a jumble of stuff that's a blur to us. And the clarity, like what you just said, John, on 26%, clears the mind.
Yeah, the details of how to fix Social Security don't gather the headlines of a fistfight or an elbowing, and it's harder to parse through all of that in a granular way on morning television. And so at a certain point, people gravitate to these other sort of posturing stories in a much more significant way, and that's what politicians follow to generate support. How much can we really get something done? What she was saying, a commission, something that can actually be divorced from the sort of partisan politics, has to be the way to go.
You think that's possible?
No.
No, I hope so. Problem?
I hope so. I hope so, because at a certain point, it does become unsustainable. And we are seeing reactions in markets.
What does a 125 sterling do to people in the United Kingdom? That's a move.
It's a change of course.
Off the weak dollar. No, it's not. I mean, everything's a jumble off of yesterday, including 109 euro in a 125 sterling. I mean, that's almost a shock number.
I love the inflation print in the UK today. I think it came in at something like the lowest in 2 years.
Yeah.
Real big
Mission
pullback year over year. Yeah, Rishi Sunak, the Prime Minister, coming out and trying to take some credit for that, which I thought was slightly humorous. Coming up very shortly, Bruce Kasman of JP Morgan's going to weigh in on some of this mess. Equity futures right now, this ain't a mess. What a move in the last 24 hours. Big move high yesterday, inching high today. Equities up a third of 1%. Fight Club in DC up next.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
All it took was a small downside surprise on inflation and boom, this equity market spiking higher and rallying aggressively into the close. Equity futures right now positive 1/3% this morning. The Nasdaq up by 1/2%. Yesterday, the best day of gains on the S&P since April. Small caps, the Russell, up another 1/2% this morning, and more than 5% yesterday, Bramo, for the best day of 2023.
Markets were